Before we begin the Capital Network's Emerging ASX Gems Investment Conference, we would like to acknowledge the traditional custodians of the various lands upon which we meet around our country today, and to pay our respect to elders past, present and emerging, recognising their ongoing cultures and connections to the lands of this country. Before our broadcast begins, please also be advised that all of the information provided today is general in nature and does not take into consideration your objectives, financial situation or needs. Before making any investment decision, you should always seek independent and licensed advice, which takes into account your specific circumstances. Welcome to the Capital Network's Emerging ASX Gems Investment Conference. We've compiled established speakers across a diverse range of industries to discuss emerging trends and ideas. In the hours ahead, you will hear from the top executives, directors, CEOs, managing directors, and industry leaders from ASX-listed companies. They will highlight how they are pursuing emerging trends and ideas to generate shareholder value. Each speaker will spend 10 minutes addressing a different aspect of this theme by introducing the company they represent, as well as their company's growth plans and upcoming catalysts. We do hope that you enjoy these voices and enjoy sharing their opinions. We would also love to hear your opinions and welcome you to join the conversation across TCN's very own social media platform.
For inviting me to speak at the TCN Emerging ASX Gems Conference. My name's Michael West and I'm the Chief Technology Officer for Exopharm, an Australian ASX-listed biotechnology company. Exopharm listed in December 2018 with the mission of enabling pharmaceutical companies to deliver therapeutics in novel ways. Since 2018, Exopharm has established itself as a leader in the production, characterization and use of exosomes to improve drug delivery in the body. But we're getting a little bit ahead of ourselves. First, I'd like to help you understand what exosomes are and why we consider them to be game changers. Exosomes are very small particles produced by cells in a wide range of cell types, from plants all the way through to humans. To provide some idea of scale, if a cell were a basketball, the exosomes they produce would be roughly the size of a pea. These exosomes are made up of the components of cells. They're little bits of cell wall formed into a sphere, and they carry the components of the cell with them. In nature, they function as messengers between different cells, sometimes in different parts of the body. They deliver information in the form of peptides, proteins, and even nucleic acids to the cells that they're targeting. It becomes immediately obvious then that if we can harness these natural messengers, we can deliver the message that we want to send to cells to the particular cells that we choose. This is the basis of Exopharm's technology and where our efforts have focused over the past 4 years. Exopharm has developed technologies in 3 core areas to enable the use of EVs in the delivery of genetic medicines. The first challenge was to be able to produce EVs in a scalable way, reproducibly and with high purity. Exopharm's elite technology achieves this goal and has been validated with several external partners. The second challenge relevant to today's talk is the ability to load cargoes into EVs. We have demonstrated the ability to load a variety of different cargoes into EVs and shown that these cargoes are taken up by cells. The final technology that Exopharm has been working on, EVPS or targeting, whilst very exciting, is not relevant today to today's pipeline products because we propose to deliver the EVs directly to the target cells. Exopharm proposes to demonstrate our technology by addressing two important cargo delivery programs. The first is aimed at cystic fibrosis, a disease resulting from mutations in the CFTR gene, which result in malformed CFTR protein. There are over 170 different mutations to the CFTR gene known. What they have in common is that they reduce the ability of the cells, most notably the lung cells, to manage water and chloride ions. The management of water and chloride ions is important because without that, the lungs form a thickened mucus layer, are more susceptible to bacterial infection, and progressive loss of lung function. Our approach is to provide the code for the correct CFTR so the body can make the right protein and resolve the condition. RNA delivery appears to be the best approach since the protein itself is complicated and membrane bound, which makes protein delivery difficult, while the alternative, editing the DNA, involves multiple cargoes that must be delivered to the nucleus of cells. RNA, in contrast, need only be delivered to the cytoplasm of lung cells, and the normal cell machinery will then take over and produce the correct CFTR protein. Our second project involves the delivery of the code for a precursor to elastin. Elastin is one of the extracellular matrix components that makes tissue flexible and resilient. One obvious indication for this type of product is in aesthetic medicine, the treatment of damaged and aging skin, and that's certainly a consideration for us. Elastin has far broader potential though, being relevant in scar repair, wound healing, the treatment of hardening of the arteries, and reduced lung function. In fact, anywhere that elastic tissue is important. Exopharm is poised to capitalize on these exciting programs. My team and I are excited to be embarking on these development programs, and I look forward to updating you on the progress as we proceed. Thank you for your time.
Medallion Metals is an advanced gold and copper explorer with a portfolio of high-quality assets in the southwest of WA. The company's aim is to build a critical mass of metal at the project to support the development of a long-life, low-cost gold and copper project in Ravensthorpe. And this presentation is an overview of what Medallion team's doing to make that aim a reality. The presentation is lodged with ASX. It's on the platform. It's a general update. It's not an offer. It's not advice. So Medallion's competing with a host of other gold and copper explorers for capital, for attention, and how do you stand out from the crowd in what is a crowded space at the moment, a difficult market for gold explorers. We think these points, when taken together, are what set Medallion apart from much of its competition. First and foremost is that Medallion controls the majority of a greenstone belt in Western Australia that's known to host and known to be fertile for gold and copper. These assets are increasingly rare and at some point in time will be extremely valuable. The assets are located 500 kilometres from Perth. The access, the infrastructure is outstanding. The community is supportive. It's had a long association with resources that stretches back for over a century. We've got scale. Importantly, we've got grade. There's a 1.4 million ounce gold equivalent resource at 2.6 grams already established. It's shallowly drilled. It's open along strike. It's open at depth. It is being grown rapidly as the drilling program unfolds. The asset's de-risked from granted mining leases, clear from a heritage perspective, advanced permitting significantly, and we've completed a feasibility study on the project resources that demonstrates Ravensthorpe will generate high margin ounces. And we think that's a compelling argument to go and look for more of them. We're extremely active. We're well funded. We've completed 46,000 metres of drilling since we listed in 2021. There's another 10,000 metre program underway at the project to grow the resources, to advance the regional exploration pipeline. And all this is being done with a view to establishing that critical mass of metal that will enable us to build a mine at Ravensthorpe. Now, internally, we think that's 800,000 ounces gold equivalent. That would give us a minimum mine life of 8 years at a run rate of 100,000 ounces per annum. So that amount of metal in the reserve is what we internally think is critical mass. And we're very confident that Conduit itself can host that metal. And then the regional exploration opportunity is just upside from there. Just touching on corporate, 230 million shares out. We showed cash of $5 million at the end of September. We've got a loan to our major shareholder. It's only repayable in the case of a change of control event or if we decide to build the project in Ravensthorpe. There's a listed investment in our neighbours Nickel Search. And when this presentation was put together, the company had a market capitalisation of $38 million. If you adjust the cash, the debt, the liquid investments, that backs out an enterprise value of $35 million. And based on the current resource estimate, that results in a $28 per ounce EV valuation. And I'll touch on why we think there's a great deal of upside from there on the next slide. In terms of leadership, the names here on the slide will be well known to people who know the junior resources sector in WA. John has been a long-term prominent member of the Northern Star board, and he's also held non-executive positions on a number of successful juniors in recent times. Ed Ainscoe, currently running Medallion Metals, achieving great things there, and Tony James, similarly, is building something of great significance at Galena. So these guys are at the forefront of the industry, the forefront of capital markets, and that experience provides a tremendous overlay to what is a young, hungry, talented senior executive team. And then there's me really just standing in the middle, directing traffic there. Touching on valuation, this is a peer group of Western Australian gold explorers. What's common about them is that they're all ASX listed and their principal asset is in WA and is gold and is at a pre-production stage. And we're sitting at the wrong end of this curve in our view. We don't like being there. It's extremely frustrating, but we can't complain too much. The market's got its reasons. All we can do is continue to deliver positive results, positive drilling results like we did at the Flag deposit last week into the market, reinforcing confidence and building awareness that we're headed towards that critical mass. And we think that when the market builds confidence and builds awareness that we are on that pathway, then we begin to move to the left-hand side of this curve. And if you leave an increasing resource multiple on top of an increasing underlying resource, then we think Medallion looks compelling from a valuation point of view. So zeroing in now on the company's principal asset, the Ravensthorpe Gold Project, Medallion has the dominant land holding in the Phillips River mineral field. And critical to that are the Annabelle volcanics, the tenements that straddle the Annabelle volcanics. And these are mapped in pink in this slide here. And it's these rocks that have hosted all of the historic production and are host to all of the known resources and the known prospects in the area. There's been approximately 130,000 ounces of gold, 20,000 tonnes of copper produced from this area historically. That's come from 3 clusters of mines at Ravensthorpe in the north, down at Alverton on the southeastern flank of the belt, and then at the Conduit Mining Centre at the southern end of the field. Interestingly, these rocks are also host to the pegmatites that Allkem are mining at the Mount Catlin project. It's down at the Conduit Mining Centre. If you think about the historic production that's come from this area, in gross metal value terms, in today's prices, it's roughly a 50-50 split between the gold and the copper in terms of value that's been produced here. So we think copper is going to have an increasingly important role to play in the story at Medallion as it develops over time. And we're certainly seeing that in the drilling at depth at the Conduit Mining Centre, particularly at the Harbour View deposit. And it's at Conduit that the bulk of the activities, the bulk of the expenditure, and the bulk of the resource growth is expected to come from in the medium term. Just zeroing in on the Conduit Mining Centre itself, we think that the project value, and then by direct extension, the company's value, is massively leveraged to increases in the resource that lead to increases in the mine plan. So that really means finding economic ounces, and that's what we're focused on here at Medallion. There's currently 1.1 million ounces of gold, 50,000 tonnes of copper metal estimated within the mining lease tenements here, the granted mining leases. 67% of that is in the indicated category. 80% of it is within 150 metres of surface. So still very shallowly drilled for an Archean gold lode system. The average depth of drilling is 100 metres. The deepest hole we've got into the system is 370 metres below surface. The lodes are all open along strike. They're open at depth. And there's been an aggressive program underway since we listed in March of 2021 to demonstrate those lodes are open and continuous over long distances. In June of 2022, this year, we completed our first mineral resource estimate update. It was based on 26,000 metres of that drilling. It led to us getting to the point that we are at the moment. That was achieved at a cost of $11 per ounce on a gold equivalent basis. For every metre that we drilled, we added 23 ounces on a gold equivalent basis into the inventory, and we expect those rates of growth will continue as the drill program unfolds. There's another resource update coming in November of this year, just next month. It's based on another 13,000 metres of drilling that was completed in the first part of this year, and we continue to think that those growth rates will be coming through. Importantly, approximately a third of the drilling that's been undertaken at the project so far has been diamond. This has led to a step change improvement in our understanding on the structural controls of the mineralisation here at Cunliffe, and that in combination with downhole geophysics has enabled us to be a lot more predictive about where these lodes repeat and extend at depth. This is a long section through Cunliffe looking to the west. Over the 2.5 kilometres of strike length as we currently understand it. This is the mineral resource. It's indicated in blue, inferred is in grey. Now, interestingly, the ounce per vertical metre profile here at Cunliffe peaks approximately 7,100 metres below surface. This is where the data density is at its greatest. And we're adding data along strike, we're adding data at depth. And if that ounce per vertical metre profile could be maintained from surface to a depth of 500 metres, then the area starts to get really interesting in terms of its scale and significance. It's a great address. It's got great potential. We think Cunliffe's got multi-million ounce potential over the longer period of time. We also mentioned that we're very interested in finding economic ounces. So critical to that is understanding what portion of this resource is going to have the potential to convert to reserve in the future. Now, we've commenced open pit and underground optimizations based on the parameters at the top of this slide. That are very recently completed work. This information is just filtering through and will report in greater detail in coming weeks, but we're very encouraged by what we're seeing. This is what's dropping out of that analysis. We're seeing 75% of the existing metal in the resource reporting to those diluted shapes in the open pit and the underground analysis. 58% of that metal is in the indicated category. The grades are generally in line with our previously stated reserve estimates when you report them above those cut-off grades. The strip ratios for the pits are averaging 6:1. So very encouraging. This is telling us what the balance of infill and extensional drilling is that we need to do next year, subject to funding being available, in order to get us to that critical mass. So just touching on where we've been, where we are, where we're going to. Medallion's been extremely active since it listed in 2021. We've done a great deal of drilling, and what that's done is give the business momentum. So there's been resource updates. We've got another resource update coming next month, and then that resource update will be the basis for us to start a pre-feasibility study at the Cunliffe Mining Centre. We'll start that work before the end of the year, complete it in the first half of 2023, and that'll tell us a number of things. It will tell us the size of the prize in Cunliffe. It'll provide us with parameters with which to go and re-engage with regulators. And finally, it'll tell us exactly where the drilling needs to be done to get us to that critical mass, and what proportion is growth and what proportional is de-risking of the asset. So next year, really all about optimising the preferred development pathway. So to wrap this up, we think Medallion is a compelling opportunity for investors who are looking for exposure to advanced gold and copper exploration in Western Australia. What you get with Medallion is dollars in the ground. You'll get resource growth We own assets in a tremendous jurisdiction. We've got great potential. The resource is growing every day as we continue to unfold the drilling program. The regional exploration opportunity, it's real and it's extensive. And while it might not get tested in the short term, it's not going anywhere and it represents tremendous upside. So if you haven't done so already, I'd encourage you to take a closer look at Medallion. Contact us through the website, set up a meeting. We're always keen to talk about where the business is headed and what's going on down at Ravensthorpe. Thank you.
I'm Brad Lingo, Chairman of Pilot Energy, and I'm happy to provide you this corporate update on Pilot's progress with its Midwest Clean Energy Project through the Capital Network. As we are a public company, here is our compliance statement disclaimer. We do take all of our shareholder communications with a high degree of care, and that's outlined in this compliance statement. Now, in terms of key messages, the Midwest Clean Energy Project is Pilot's flagship energy transition project. We are a producing oil and gas company. We are transitioning into the supply of clean, low-cost energy. Our existing operations in Western Australia are ideal for this transition to provide low-cost carbon capture and storage and clean hydrogen and ammonia production. The Midwest Clean Energy Project is our flagship clean energy transition project. And from the Midwest Clean Energy Project, Pilot aims to produce the lowest cost clean energy for the export of clean ammonia. Carbon capture and storage is a key component of that, and it is the key enabler to being able to deliver that lowest cost clean hydrogen ammonia. Utilizing Pilot's existing offshore facilities, the Midwest Clean Energy Project provides a unique opportunity for offshore CO2 storage and clean ammonia export. It also provides Pilot with a unique opportunity to offer a bi-directional carbon trade through dual-purpose liquid CO2 and ammonia carriers. We aim to provide permanent injection and storage of over 1 million tons of CO2 annually through 2050. And in the Midwest Clean Energy Project, we aim to produce initially 345,000 tons per annum of low-cost clean ammonia for export by 2027, expanding that up to 1 million tons per annum. So our vision is to transform those existing assets and infrastructure, delivering an integrated, cost-competitive clean energy project. Those current operations are centered around the Cliffhead oil field sitting in Commonwealth waters and the existing infrastructure that ties that oil production operation back to the Midwest coast, and to transition those assets first into carbon capture and storage, and then use that carbon capture and storage and onshore facilities as a clean energy resource hub, integrating wind, solar, and the production of clean hydrogen and ammonia. So the Midwest Clean Energy Project. Stage one is carbon capture and storage, the conversion of the Cliffhead oil field to CCS, the provision of permanent CO2 storage in the depleted oil field reservoir. It is offshore facilities do provide us the opportunity for direct offshore liquid CO2 receipt. And as I indicated earlier, that we're looking at providing up to 1.1 million tons of CO2 injection capacity from 2025 and targeting continuous CO2 injection through 2050. Overall, that supports our next stage development of developing a clean hydrogen ammonia for export production project. That project is based on a combined blue and green hydrogen production to feed an ammonia plant. That clean ammonia and hydrogen production will rely on and utilize the Cliffhead CCS project. It also involves the integration of up to 250 megawatts of renewable energy in terms of wind and solar at a very competitive levelized cost of energy, and targeting that initial clean ammonia production of 345,000 tons per annum at an estimated blue hydrogen LCOH cost of approximately Australian $2 a kilo, and clean ammonia production and LCOA cost of approximately Aussie $400 a ton. Now, the overall overview of the Cliffhead CCS project, it is located, as you can see from the map, along the Midwest coast, about 300 kilometers north of Perth. It is a brownfield redevelopment using all of the existing Cliffhead oil field onshore and offshore facilities. Because it sits in Commonwealth waters, there is a existing relatively straightforward regulatory pathway for the repurposing of the Cliffhead oil field into a CCS project. Because of all that existing infrastructure, it does present minimal risk and CapEx requirements due to the straightforward adaptive reuse of that existing plant, pipeline, wells, platform, and reservoir. The project is to include both onshore CO2 capture and aggregation and offshore CO2 injection facilities. It has proximity to readily accessible markets with up to 1 million tons per annum of easily to capture CO2 emission sources. And we are looking to provide that carbon capture and storage at a LCOS, or levelized cost of storage, of less than Australian $20 a ton for CO2. It is the foundation development for the Midwest Clean Energy Project, and we are targeting first CO2 injection mid-2025, 2026. So why CCS? It is essential to meeting Australia's greenhouse gas reduction targets, and it is the key enabler of being able to deliver the lowest cost clean hydrogen and ammonia. CCS is proven, it's safe, it's permanent, it's commercial, it's necessary, it's a key enabler, and it is essential to be able to provide decarbonization of key fundamental industries such as cement, steel, chemical, and fertilizer production. So in terms of how does the Cliffhead CCS project compare to global CCS facilities in operation? Well, at first we thought it was going to be a relatively small to modest-sized project, but then when we looked at the existing CCS projects currently operating, at 1 million tons per annum, Cliffhead CCS project will be a top 10 project in terms of projects currently in operation. So it does leverage quite significantly off that existing infrastructure, which you can see both diagrammatically and photographs of the existing offshore platform and onshore plant. And you can see its close proximity to existing CO2 sources. Step one of the project is to prepare the reservoir for the CCS project through the completion of the final oil production from the Cliffhead field. Step two is to convert those existing facilities. Planning for that conversion works to happen in late calendar year 2024 into first half of 2025. And then to commence CO2 injection into the field in late 2025, early 2026. We also, as I indicated earlier, we are very much looking at including direct CO2 receipt offshore. That enables us to focus on taking CO2 from the large industrial CO2 emission center south of Perth in the southwest Western Australia, as well as to potentially look to provide complementary carbon capture and storage project for CO2 emissions from the Northwest Shelf, as well as internationally. That also provides us an opportunity for the potential to offer a bi-directional carbon trade, where we can supply customers with clean CO2-free ammonia as a new emerging hydrogen energy source. And on the return trip, those vessels that are delivering ammonia can also bring back CO2 for sequestration. So doubling the CO2 reduction impact by signing up for energy supply from Pilot. So in terms of that overall impact of the project, at 500,000 tons per annum of CO2 injection, the Cliffhead CCS project is the equivalent of planting 35,000 hectares in agroforestry, or the equivalent of 57 million trees per annum, year in, year out for the next 25 years. Ultimately, our CCS to ammonia project leverages quite heavily off of a unique technology that we have contracted with 8 Rivers Capital, which is a proven clean power and hydrogen production technology that enables us to, one, produce on an integrated basis both blue and green hydrogen at an extremely competitive cost with near zero CO2 emissions. In terms of what does that deliver in terms of the cost of blue hydrogen to clean ammonia, as you can see quite competitively from this slide, that our blue hydrogen cost is only slightly higher than current gray hydrogen cost, where CO2 is vented, but nearly half that cost of competing green hydrogen production on a standalone basis. And when we integrate those two together, that gives a commanding competitive cost for the production of clean ammonia at approximately $400 a ton Australian, which is, again, less than half that cost of ammonia production from simply a green hydrogen production stream and well below current market prices. So part of that overall development does include the integration of renewable energy, both in terms of onshore wind and solar, into the overall project. Our work that we've done in our detailed feasibility studies so that we can deliver and harness that very rich renewable resource in the Midwest at a very, very cost competitive basis, delivering very low LCOE costs for both wind and solar, and very high capacity factors. And when we put that all together with our blue hydrogen clean power production system, that's what drives that ability to deliver that very low cost ammonia for export. So bringing it all together, it is an integrated project involving carbon capture and storage, blue hydrogen and green production, and the integration of renewables. Ultimately, we're expecting hydrogen production to range between 43 and 85,000 tons per annum. That'll feed into our overall hydrogen production, our overall ammonia production, and that overall ammonia production targeting an initial capacity of 345,000 tons per annum and growing up to over 1.1 million tons of cost competitive clean ammonia for export. Bit of a core overview. We really see ourselves at a point where we're likely to have a significant re-rate as we complete our regulatory process and approvals for the carbon capture and storage project. When we compare ourselves to our peers, we see that there's quite a significant gap for us to be able to span in terms of valuation, in terms of our enterprise value to our clean resource production capacity coming out of the Midwest Clean Energy Project. We've got a very stable and reliable shareholder base that supported us with over 95% shareholder approvals, and in most cases, an absolute majority of shares backing the plan that we're delivering through the Midwest Clean Energy Project over the last 5 shareholder meetings. Key next steps. We are engaging with prospective partners and customers for the Midwest Clean Energy Project, as well as the Cliffhead CCS project. Project permitting, project implementation. Permitting is a key inflection point for us. Within the next month, we will be launching our applications for approval for the CCS project. We are actively in the process of site acquisition for the CCS project for additional onshore facilities, as well as to support the blue hydrogen production facility and integrated renewables. We're negotiating commercial offtake for both CCS as well as ammonia. And we are moving into the feed for the CCS project and pre-feed for the blue hydrogen project, and start that engagement with EPCM contractors to help us execute and build the project out. I thank you for their time, and It's our pleasure to provide this pilot corporate update on the Midwest Clean Energy Project through the Capital Network.
Hello everybody, my name is Scott Kelly. I'm the Australian CEO of Real Asset Management. REP is a ticker for the RAM Essential Services Property Fund, which is an ASX-listed REIT managed by Real Asset Management. We are a fully independent wealth and asset management business focused on three areas, being real estate, credit, and to some extent private equity. We manage over $4 billion of assets. More interesting answer is that it's a unique investment vehicle that invests in a combination of 35 high quality defensive essential retail properties, supermarkets, and pure medical properties, private hospitals and medical centers. In doing so, it generates rock solid income that grows ahead of inflation over time. That cash flow is stable due to the fact that we have high occupancy in our assets, 99%. Strong annual inbuilt growth escalators. 90% of the leases are exposed to annual escalators, and the leases are long. The weighted average lease expiry is over 7 years. Additionally, we add value to the portfolio by so-called sweating the assets to improve them and expand them over time. And this adds capital growth into the mix for our investors. Listed real estate in Australia is dominated by office and what you might describe as the wrong sort of retail. About 80% of the market are those two sectors, in fact. So this vehicle also offers investors a rare chance to invest in scarce assets, including medical, in a listed environment. It's property, so it's not rocket science. It comes down to three things. Firstly, we look for well-priced assets to buy that help us to achieve what I've just described. It's important not to overpay, and our track record of buying assets in competitive markets points to a very strong capital discipline. For instance, over the course of 14 months, we bought 21 medical assets in a very tight market at an average yield of 5.6 at a time when others were doing deals at yields of 4%. Secondly, we look to enhance those income streams from those assets and also increase the value of them with activities such as releasing, repositioning, aesthetically improving them to get better rents, longer leases, better tenants, and better terms from those tenants. This could also include modifying or expanding the assets to get more lettable space. We summarize these endeavors as value add activities, and we are currently diligently working through $200 million of these type of opportunities and projects that will take us up to 3 years. The result is organic growth, both of income and capital. Thirdly, we trade the portfolio. We're constantly looking to recycle the capital by selling assets where we see limited upside because we've extracted as much value from them as possible in favor of those assets where we feel we can add more value. We did this just a few months after listing earlier this year, and we're looking to do far more. What are the upcoming catalysts? Well, we look at that from two perspectives, from the viewpoint of the underlying portfolio, the assets, and how they're being traded on the listed environment. In terms of the portfolio itself, demand for medical properties is driven by strong demographic and social trends, such as an aging population and an increased focus on preventative healthcare. We are spending more money on healthcare than ever, both at a personal level and also at a government level. Similarly, there are supportive trends in essential convenience neighborhood retail, with a shift in consumer preferences to shopping locally, fueled by things such as working from home. In terms of the listed space and the REIT sector in particular, the macroeconomic environment needs to change. When we start to price in the fact that interest rates and inflation will at first plateau and then start to price in the fact that rates will start being reduced maybe at the back end of next year, then we'll see a big catalyst for interest rate sensitive stocks such as REITs to move up. Markets typically start doing that around 9 months ahead of the actual rate move, so it's probably not too far off. Our stock could rise over 30% before it gets back to fair value. By fair value, I mean the value of the underlying assets in the portfolio. Additionally, first movers will be able to lock in an amazing yield. Our REIT is currently yielding over 8.5%, which is crazy for such defensive cash flows and indicative of the sentiment around equity markets right now. That's a compelling combination in my view. Then how do we create shareholder value? We create shareholder value through the prudent acquisition and management of a diverse range of 35 high quality defensive assets in a portfolio that generates both very attractive income and capital growth over time. These assets are either pure medical, private hospitals and medical centres, or essential retail, supermarkets and neighbourhood centres. The growth comes from two sources: through baked in annual escalators written into the leases, and through so-called sweating the assets, which means improving them with low-risk projects, repositioning them, releasing them, and so on, to generate added value. The fund also gives investors access to scarce assets, especially the medical side of the portfolio. Less than 1% of listed real estate in Australia is medical. Finally, by being a prudent steward of capital, and for instance, managing costs, including interest rate costs, which is very topical, and being disciplined with how we deploy investors' capital.
Well, it's great to be here today with the Capital Network as part of the Emerging ASX Gems series. Today, I'd like to talk to you about the critical importance of battery-grade lithium chemicals in the European Union, and how Infinity's fully integrated San Jose lithium project will be powering a sustainable future in Europe. Please take a moment to have a look at the various disclaimers, as I will be making forward-looking statements and representations about the San Jose project. The San Jose lithium project is a fully integrated lithium project located in Spain, approximately 3 hours from Madrid. The San Jose fully integrated project will use Europe's second largest hard rock lithium resource to act as feedstock for a large-scale lithium chemical conversion plant to produce close to 20,000 tonnes of battery-grade lithium chemicals over a 26-year period. The requirement for lithium chemicals is urgently required in Europe to power this move to electric vehicle adoption, primarily for the use in high nickel content cathodes. At a project level, we have just returned from Spain, having negotiated the initiation of the permitting process, and this has been done in collaboration with local stakeholders and the regional government. The regional government of Extremadura has also recently ratified a lithium decree law, which essentially requires all lithium that is exploited in Extremadura to be converted in Extremadura. So ultimately, the San Jose project acts as a blueprint for all future projects. We have a board that is now primarily based in Europe, close to the project, and we have a highly credentialed Spanish CEO that was appointed earlier this year, driving much of this local engagement. We have a highly credentialed and experienced technical team that has been involved in a number of lithium chemical conversion projects, so we are ideally now placed to progress the San Jose lithium project into production for 2026. At a corporate level, we see close to 416 million shares on issue, and ultimately a market capitalisation of close to 92 million Australian dollars. We have close to $16 million cash in bank at the end of financial year. So an overview of Europe sees a very significant requirement for battery-grade lithium chemicals, more than 800,000 tonnes by 2030, really against the backdrop of global production of less than 700,000 tonnes of where we sit today. This is highly concentrated in China. China will be the largest producer of electric vehicles, lithium-ion batteries, and ultimately require the greatest amounts of battery-grade lithium chemicals. So there is really a global race at the moment to secure these key battery-grade lithium chemicals for the use in high nickel content cathodes. This strong EU demand is against the backdrop of more than 1,000 gigawatt hours of lithium-ion battery plants in construction or projected by 2030. Europe is now moving aggressively towards strategic autonomy for these critical materials and seeking to exploit lithium, nickel, copper, and other critical materials within the European Union. Against the backdrop of ongoing geopolitical tensions and supply security, globally, more and more markets are looking at localized supply chains, and Europe is no different in this case. Europe is now aggressively moving to adopt a Critical Raw Materials Act and to announce strategic European projects, which will facilitate accelerated permitting and access to unprecedented levels of funding. Lithium is already recognised in the European Union as a critical raw material, so it's clear that lithium will cornerstone this move towards electrification. At a regional level, we've seen the Extremadura regional government pass a lithium decree law. And as I stated previously, this requires all lithium that is exploited in Extremadura to be converted to chemicals in Extremadura. This declaration of a lithium decree has also seen now projects of this nature, such as San Jose, which is fully integrated, recognised as projects of regional interest, and this has various advantages. Most importantly, this notes an accelerated administrative processing or permitting application process, which is relevant to us as we start to now look forward to discuss some of the catalysts that will be available to our shareholders. The permitting process has been initiated following our recent trip to Spain, and this has been done in collaboration and consultation with the regional government. We have lodged what is seen or is known as an initial document, and this is an environmental impact assessment scoping document. We are collaborating with authorities to determine the key characteristics of the project, including the location of the downstream lithium chemical conversion plant and the nature of our tailings profile. We expect to have feedback from the government before the end of the year that will determine the key requirements to lodge our exploitation concession in Q1 next year and facilitate an accelerated pathway towards a permitting outcome. The project itself sees various sustainability credentials, which is all important in the European market as they strive towards zero carbon footprint products and against the backdrop of a move under the EU Green Deal. Furthermore, the European Union will be governed by a battery passport, which measures the CO2 profile of all batteries within the European Union. We have recently redesigned our project to move underground from an open pit, and there are some very obvious advantages in that, both in terms of local engagement and in terms of sustainability credentials. The move underground follows the historical nature of the location of the resource. This is a tin mine from the 1960s. You can see the shafts, the dilapidated buildings, and ultimately the move to an underground project receives the strongest support politically and from the local community. The move underground also facilitates the return of much of the waste underground through paste infill, with more than 60% of the waste material now returning underground. The surface tailings are primarily dry stack, so that allows us to continually rehabilitate the site. And how we facilitated that is through the development of a patented process that allows for the recycling of key agents and the introduction of sulfate in the kiln. We're able to use this process now to provide a much more sustainable process and step away from traditional hard rock lithium chemical conversion processes that use vast amounts of sulfuric acid. Extremadura also currently speaks for close to 25% of Spain's photovoltaic power. So we are able to tap into this green energy to power our processing plant and move towards an electrified mining fleet. We are also working closely to consider the adoption of green hydrogen with ThyssenKrupp, a global leading expert out of Germany, and ultimately that can further reduce our carbon profile through the mix with natural gas to power our kiln. In terms of proximity, we have the resource and the conversion site located on site. Ultimately, they're 1.5 to 2 kilometres apart. So we have a very small carbon footprint when compared to other lithium mineral extraction projects globally that move that resource to other markets or other locations around the world for lithium chemical conversion. And ultimately, our end product will be in very close proximity to these key EU end markets. So ultimately, a much lower carbon footprint in terms of transport costs and also in terms of transport footprint. Our project itself sees very robust economic highlights, highlighting a pre-tax NPV of close to $811 million US based on 100% project ownership. It's important to note Infinity currently holds 75% of the project with a call option to move to 100% of the project at any time prior to the final investment decision. The pre-tax IRR also highlights an incredibly viable project, noting a conservative pricing assumption when the study was undertaken in Q4 last year at US $17,000 a tonne for battery-grade lithium hydroxide. The current spot market sees close to $80,000 a tonne and a longer-term outlook of between $20,000 and $30,000 a tonne. So there's plenty of blue skies in terms of the economic opportunity for this project and value to shareholders. We see a project that will produce, under these assumptions, close to 8 billion euros or $8 billion US as well in revenues, and capex of close to 532 million US dollars, including contingencies. This is a long life project over 26 years and a resource that remains open at strike and depth. So ultimately there's plenty of upside to scale up in the future. However, under our current analysis, we're assuming a project of 26 years. The project itself sees many key characteristics that are extremely important for the European Union and also for Spain to develop their own lithium-ion battery value chain. Infinity Lithium is creating shareholder value through the advancement of this world-class project to deliver critical raw materials and battery-grade products that are required for the European Union. We are ultimately going to be cornerstoning this move to electrification in Europe as they move towards total electrification over the coming decade.
Julia McCormack from Platinum Investment Management. What do you believe are the biggest emerging trends that are going to impact 2023?
Good question. So the trends that will impact 2023 will be, in my view and our view, transition from obsession with interest rates and inflation to the emergent reality and acceptance of a recession. So we have never gone from periods of high inflation to periods of low inflation, absent a recession. That takes quite a long time and it takes quite a long unemployment rate. So to make that more concrete, we've never had average hourly earnings of 5% plus return back towards target of, say, 3% without a 10% unemployment rate. That's clearly going to affect the environment in 2023, in our view.
What are your preferred emerging sectors or stocks?
So in terms of preference for stocks and sectors, the rather gloomy thing we'd suggest to people is you actually want to have a lot of cash, and if you can, you actually want to be short markets if you're confident to do that. But put it more broadly, you want to be thinking about preserving capital in this kind of environment. We don't invest through recessions very much, and we don't invest through bear markets very much. We only get a few in a career. So it's important to preserve capital through those. That's for the next 18 months or 2 years or 6 months. We don't know, but it's for the immediate term. Longer term, out the back of a sort of investable timeline of sort of 3 to 5 years, then we're beginning to think about sectors that benefit from a much higher nominal growth world. Right? There's no such thing as stagflation. That doesn't exist. If you go and check growth rates in the 70s, they were very high, right, by modern standards. So you either grew at 5% real or 0 real. You didn't grow at a steady 2 or something. It wasn't stagnant at all. And also the sectors that benefit from a high nominal growth world are very different to those that worked in the last, say, 10 years, in the last investing cycle. So it won't be, stable consumption type plays like a Nestle, and it won't be long dated tech type plays, say a software as a service type thing. The billionaires of the next cycle will be much more like the billionaires of 2 cycles ago. So, think about the emergence of Twiggy Forrest or Ike Batista in Brazil. The kind of things you want to be thinking about are energy, clean energy and the energy transition, battery metals, metals and mining in general, clean tech in general, so plastic replacements, or that kind of much more real world type exposure.
What emerging trends should everyone learn more about and why?
So in terms of emerging trends, people need to understand what it means to go from a low inflation to a high inflation environment. And I think most people think that is just a change in prices. But think about it. We don't go from a world that has everything on average going up in terms of price by 2% to everything in average going up by 8%. There's a wild volatility that creeps in terms of pricing between different goods and in terms of pricing through time, right? So that is a very, very different environment. You cannot afford to pay high multiples in high inflation type environments. It's a very, very different environment in which to invest. So much more focus on cash flow and free cash flow, much more focus on dividend and sort of return immediacy, because long dated promises just cannot hold their value in the kind of inflation environment that we think we're in quite durably here.
Welcome to TCN's Emerging ASX Gems presentation for Paws. Thanks for joining us today. My name is Justus. I'm the co-founder and CEO of Paws, and I will tell you a little bit about Paws and our plans for the future. So let's get right into it. Just a quick overview of what everyone here at Paws is working towards. We exist to enable pets to live their life to the fullest, and it is our goal to become the most trusted and convenient brand to rely on for all pet-related needs. And as you can see on this slide, Paws is well on its way. We're already providing products and services for pet owners in a lot of different verticals, and our focus is on delivering best-in-class products and services. Paws is Australia's dominant pet services marketplace, where we've built a community of over 35,000 trusted local pet sitters who provide 5-star pet sitting, walking, daycare, and grooming services to pet owners in their communities around the country. And you can see Paws here on the left-hand bottom. We also offer the #1 rated pet food offering to customers in Australia with Dinnerball. We're running the leading toy subscription service with Waggly, as well as having the leading online pet pharmacy with Pet Chemist. So why are we so excited about the strategy? We see a huge opportunity to become the leading destination for customers to get educated about being a better pet owner and incentivizing customers to stay within the Paws ecosystem of products and services, which ultimately will allow us to be more successful than standalone players. And how do we get there? We're laser focused on building network effects by focusing on providing as many touch points with Paws for owners as possible. This is also the reason why we're focusing so heavily on our data layer, learning as much as possible about our customers with every interaction we have with them, using that information to tailor better products and services for them. And we've seen huge success with this strategy already, improving our repeat rates and cohorts for the marketplace year after year. And we're using the same focus on data we're collecting on our customers. And we have signed up over 30,000 customers already just in the last quarter to drive our cross-sell strategy between different verticals, again, helping us to increase our repeat rates, drive the share of wallet, and at the same time, reduce customer acquisition cost for the whole group. So I've told you a little bit about what we're doing. Now I'm going to tell you a little bit about how we're making money in the group. I've been talking about the different verticals, but you can easily look at our business in 2 segments. One is the marketplace, and the other one are our subscription and e-commerce offerings. And you can see the marketplace here on the left-hand side. We call it Paws Care, with our pet sitting, daycare, dog walking, house visiting visits services, where we also provide subscription services on a weekly basis. So you can book a dog walker, for example, to come on a Wednesday and Friday, lock it in every week, and the service will be provided automatically. You'll be charged automatically, so it makes the whole experience extremely easy. On the marketplace, we take 20% commission from our pet sitters and a 9% booking fee from the pet owners. After GST, this turns out to be very close to 25% effective take rate. And the marketplace currently is the biggest part of our business. And it's a very attractive business. We've got a very fixed cost base now, and the business has been scaling very consistently over the last couple of years, achieving very close to 75 to 80% growth rate year on year, and we expect to see the same going forward. On the other hand, on the right-hand side, you can see our subscription and e-commerce segment, which is an online-focused offering where we're targeting margins in the range of 25 to 40%. With the different businesses achieving different results. So Dinner Bowl is more on the lower end of a margin perspective, but a very attractive business in terms of the cohorts. We're retaining customers for a very long period of time, and they stay with us on the subscription, on the food subscription, for a very long time. And we've got other businesses like Pet Chemist, which is a very, very attractive business at the moment. Being in the health space, people are much more concerned about the health of their pets these days. And they're spending a lot more on making sure that their pets are not just being fed, but being fed well, that they're also getting the right supplements that they need to live longer. And Pet Chemist is right in the sweet spot to provide products in that area. And then Wagley is also a very interesting business for us. We've really worked that business also out over the last year and a half since we've acquired that business, where we're now achieving record subscription numbers at record low customer acquisition costs. So this is really a result of us of driving those networks effects that I've talked about, and the cross-sell between the different businesses that we have to achieve record results. And Wagley, for example, is on the very top end of that margin range that you see on the bottom, achieving nearly 40% gross margin for a delivered box to our customers. So very, very attractive business for us, and we see a lot of scale in that business going forward. And you can see the results of all the hard work, I guess, over the last couple of years. On the right-hand side there, we've now really achieved a significant scale for the business, achieving a operating revenue run rate in September of $23 million. So, you know, shows you the scale of the business, and we've achieved 85% year-on-year growth on that number. Revenue for the last quarter actual was 5.4 million, which is 300% up, which is a reflection of the Pet Chemist business, which we acquired towards the end of last financial year. And then one achievement that we're very proud of, and has been a focus for us over the last couple of months in particular, is obviously profitability and reaching profitability. So our marketplace is now profitable for the second quarter in a row. We've achieved a operating EBITDA as a percentage of revenue of 20%, which was up 11% just from last quarter. And we see that improving even further. Like I said before, the marketplace, very stable cost base, and we've got a very efficient way to acquire customers now. And we see that business contributing to our EBITDA margin significantly over the next coming quarters. And for the rest of the business, we've very much focused on profitability for all the other segments of the business as well. And we're looking to achieve profitability for the whole group towards the end of this financial year. And another thing worthwhile mentioning is probably some of the iconic partners that we attracted along the way. One of them you can see on the bottom here is Qantas, who we have an agreement with as their exclusive pet services partner, which not just helps us from a customer acquisition point of view, but obviously also from a building trust perspective, which was a huge win for us over the last couple of years. So where to from here? I'm sure I'm not telling you anything new when I say that the relationship we have with our pets has significantly changed. Pets are now part of the family, and that is reflected in the pet industry's growth numbers over the last couple of years, with the pet industry now representing a $30 billion market opportunity in Australia alone. We do not only have more pets in Australia, pet ownership is up 25% since pandemic, but we also see that pet owners are spending more on their pets, and they are much more concerned about the quality of products they are buying for their pets. And this is really what we've seen playing out over the last couple of years, having that double whammy of more customers, but also the customers spending more on the products and services that we are providing. Another huge shift we've seen over the last couple of years has obviously been COVID and the acceleration and the shift that we've seen from offline to online, which helps us as a very kind of online focused business and has contributed to the growth that we've seen over the last couple of quarters. Another thing that we've seen playing out is the pent-up demand for travel. I'm sure you feel the same as me. When I was very happy to be able to actually jump on a plane again and leave the country from time to time. And we've seen that for most Australians out there as well. Our marketplace has seen significant growth over that period of time. And we're kind of coming into the golden quarter for Paws marketplace, but also for our other segments with the Christmas holidays around the corner. And that's not also has been playing out for our marketplace, but also for our recurring revenue businesses in Petchemist, Dinnerball, and Wagley, with customers being much more accepting for subscription services, which plays perfectly into the strategy that we have. And last but not least, we've got a strong balance sheet with $3.5 million in cash in the bank. We're going into the strongest quarter traditionally for us as a business, where we're seeing actually getting close to cash flow break even from a cash flow perspective. So we're very well positioned to execute on our strategy going forward, and are very excited for the next couple of quarters for the business, and we'd love to for you to join us on that journey. And with that, I'll wish you a very nice rest of the day.
Hi everyone, Thomas Lyon here, CEO of Teruga Minerals Limited. We're a South Australian focused rare earth element and copper exploration company looking to define JORC resources in 2023. Here's an outlay of our capital structure and our current position. We've got a nice chart there going upward, moving in the upward direction. We've got about 2.8 million in cash and receivables at the moment, so pretty well funded. We've got 650,000 of government funding, state government funding for rare earth element exploration and copper exploration. And the share price is around 3.1 cents at the moment. Enterprise value of 15 million, so plenty of room for growth. We've got a really great board. We've got Eric Demori and Paul Cronin, who are the founders of Emerging Metals. We've got Dave Chapman, who's the founder of Dreadnought Resources, and Gary Steinprice as well there, and Dan Smith, our company secretary. Here's an overview of our South Australian projects where we're focused. We've got big projects. Whenever I peg ground, I make sure I peg entire systems. So that's what we've done at Flinders project. That's what we've done at Mount Craig project. Collectively, our projects are about over 4,000 square kilometres in South Australia. Mount Craig project now is 1,500 square kilometres, and Flinders project is about 1,500 square kilometres as well. At Mount Craig, we're focused on clay-hosted rare earths, which we've recently discovered some high-grade clay-hosted rare earths just only a few weeks ago. And at Flinders project, we're focused on high-grade IOCG, iron oxide copper gold style mineralization, which we have outcropping at the surface. Here's the Mount Craig project, where we're currently spending most of our time and energy. We just recently announced the discovery of high-grade clay-hosted rare earths from surface here. It's a really exciting project. As I said, it's about 1,500 square kilometres. The geology is very interesting. It's the same as the Central African Copper Belt, and it contains what we call a diaperic breccia system. And that's interesting because there aren't many of them in the world. They're rare, and this is the biggest in Australia contained within our tenement. We've got high-grade copper here. We've hit sediment-hosted copper in the north end of the project, and we've just discovered high-grade clay-hosted rare earth elements, which we're doing metallurgical test work on now and looking to define a JORC resource next year. Here's where we've found our clay-hosted rare earth elements at Morgans Creek at the south end of the project. The Mount Craig project has 34 kilometres of strike, and the geology repeats all over that 34 kilometres of strike. So there's huge potential for new discoveries to be made. But at the moment, we're focusing at Hydrothermal Hill and Morgans Creek, where we've had some really good intercepts. An example there, 43 metres at over 1,600 ppm, total rare earth element oxide from surface to end of hole. Many of the holes ended in mineralization and started in mineralization. We only stopped because the RAB rig couldn't get any more sample. We're going to go back in with RC and we're going to drill deeper and find the base of mineralization. You can see there the white dots is a drill plan. So we know what we need to do to go and drill this thing out. The unit, which is containing most of the rare earth element enrichment, is very easily mappable. We've already mapped it. So we've got a clear plan about how to attack it and how to drill it. But we also know that the units around the outside of that are also mineralized. We have multiple intercepts of good grades in peripheral units to that unit. So we're advancing this to a JORC resource very quickly. We're looking to define our maiden JORC resource in 2023. And it's actually quite cheap drilling because RAB is very suitable here, and RC, it's shallow, starts from surface. So it doesn't cost a huge amount of money to drill these things out. One of the beautiful things about the rare earths here at Morgan's Creek is it's not just the fact that they're, really, really thick intercepts starting from surface, high grade, and we've been ending in mineralization over a good strike. We've got about 5 kilometers of strike that we've already proven at the project so far. But the beautiful thing here is that our basket is very high value. We've got very high magnet rare earth content, an average of 34% magnet rare earth over the 250 ppm cutoff. That's way higher than the market average. If you look at most companies on the ASX, they're around 25% magnet rare earth, and most of that is NdPr, neodymium praseodymium. The 4 magnet rare earths that make up MREO, they're the 4 most valuable rare earths out of the 15 rare earths that people report when they report total rare earth element oxide intercepts, are neodymium praseodymium, which are the light magnet rare earths, and then terbium, dysprosium, which are the heavy magnet rare earths. Now, we've got a very high proportion of terbium, dysprosium in our basket, and they're the most valuable. So that really separates us again from our peers. I'm not aware of any other companies on the ASX which have a 34% magnet rare earth content in their basket. So this is really exceptional, not just from the fact it's got no waste over the top of it, mineralization starts from surface, but the percentage of high value elements in the basket is very exceptional. We've completed some preliminary metallurgy on this earlier in the year. We had really good recoveries in an acid leach of 85% of the total rare earths and 93% of the magnet rare earths. And now we're working with ANSTO, the world leading metallurgical group who do rare earth element leach test work and ionic absorption clay rare earth element test work. We're working with ANSTO now to do independent test work on our samples and develop a commercial flow sheet for those samples. So we expect those first results to be back late November, early December. Then we're not just defining the JORC resource at Morgan's Creek, we're doing regional exploration. Morgan's Creek is about a 100 square kilometre zone in the project. We've only been drilling, really focusing this 5 kilometres of strike at the moment at Hydrothermal Hill, but you can see the image just beneath here with all the coloured dots on it. And what that shows is that when we did our recon drilling, when we're looking for copper initially at Morgan's Creek in 2021, we hit the rare earths by accident, but you can see almost every single hole hit good grades of rare earth elements over 6 kilometers by 2 kilometers. Now we haven't even returned to go and look at any of these areas. We've just been focused at Hydrothermal Hill now, but part of our exploration program moving forward next year will not just be defining the JORC resource at Hydrothermal Hill, but also exploring these other peripheral units around Morgan's Creek and throughout the Mount Craig project, which has collectively 34 kilometers of strike. And I'll show you a bit more of that now. The regional exploration here is not just at Morgan's Creek, like I said, it's the entire project. We've got 34 k's of strike. That geology extends over the 34 kilometers of strike. And we've got a clear understanding of how to explore this area. We've got radiometric targets, uranium and thorium airborne radiometrics. We've got geological targets. We know what types of units are hosting these rare earths, and we know they repeat over the project area. So there's a lot of untapped potential here. No one's ever drilled for rare earths here before. We're the only company who's ever looked at them here, and it's looking like it's quite well endowed. So here's our copper focus project, which is the Flinders IOCG project. This is about 30 k's, 40 k's away from Mount Craig project in South Australia. We're on the eastern margin of the Gawler Craton, 60 k's from Carrapateena, 150 k's from Olympic Dam, some of the world's best IOCG deposits. The difference between our project and other IOCG projects in South Australia is that we have high-grade IOCG mineralization outcropping at the surface. All the other projects that we're aware of, their deposits or their targets are under 300 to 500 meters of young sedimentary cover, and they're trying to drill through that to hope to hit the kind of mineralization that we have outcropping at the surface. So it's pretty exceptional, very standout. I'm not aware of another opportunity like this. The other beautiful thing about these projects is we have power and rail running through the lease. There are substations on the lease, gas pipelines, infrastructure, public gazetted roads. We've got major ports just down the road. We've got major towns, engineering facilities nearby, and everything's set up for a fast path to development post-discovery. Here's a little bit more information about the Flinders project. It's not just high-grade ISCG mineralization, but over 15 k's of strike. But underneath where these high-grade mineral hematite and magnetite breccias outcrop, they're mineralized with copper, gold, and silver. They've got massive magnetic anomalies and big gravity anomalies sitting underneath, which is exactly what you would expect to see with geophysical signature for an ISCG style deposit. So upcoming catalysts for the company, we've got a lot in the pipeline right now. We're really focusing on Mount Craig project right now and driving this JORC resource for our rare earth element deposit and expanding on those discoveries. So we've got the ANSTO metallurgical test work coming through. We're going to commence our JORC resource drilling in January, February next year. There'll be multiple rounds of metallurgical test work, regional exploration, new assay results coming in very quickly from the additional drilling and strike drill out we're doing, and the new targets we're drill testing. So there's going to be a very kind of constant pace of strong news flow, and most of those are going to be assay and metallurgical results, and reports of drill results from new zones that we've tested for the first time. Okay, messages. We've got a new rare earth element discovery. It's a standout from most of our peers on the ASX. We've got a very high magnet rare earth content, very high value. We've got huge projects. We own 100% of our projects. We're discovery focused. We're confident there's big exploration upside across our tenements, given what we now know about the controls on rare earth element and copper mineralization at our projects. And our tenements are very underexplored. So we're really looking forward to driving new discoveries next year in 2023 and reporting our first maiden JORC resource.
Dani from Wilson Asset Management, could you start by telling me about WAM Alternative Assets?
It's a listed investment company listed on ASX, and that's really the only LIC in the Australian market that provides access to retail and wholesale investors to a portfolio of diversified alternative investments. WAM Alternative Assets invests in real estate, infrastructure, real assets, private equity, and private debt.
And Dania, do you think that investing in alternative assets is important now more than ever, perhaps during the current macroeconomic environment?
Absolutely. Such a good question. Considering the current macroeconomic situation and what's happening in the financial markets in terms of increased volatility, investing in alternative asset classes can bring a number of benefits to investors. It does have strong diversification benefits due to low or negative correlation to other asset classes. It tends to have low volatility than traditional listed equities, and also can serve as a potential inflation hedge and interest rate hedge. What's more important, when investing in alternative assets, we can also take long-term views and invest across attractive macroeconomic themes. So as an example, within our portfolio, we invest across 4 themes. One is digitalization, second, growing demand for food, third, climate change, and finally, growing aging population.
And finally, Dania, how do you invest in the alternative asset classes?
Historically, alternative asset classes have been really difficult to access, in particular for retail and wholesale investors. And there are a number of reasons for this. First, it's quite a complex asset class. So one needs to have really good technical knowledge in order to assess the risks and return characteristics. Second, often when investing in alternatives, be it private equity, real estate, or infrastructure, minimum investment ticket size requirements are really high and usually starts from 10 million plus. And finally, those are liquid asset classes. When we make investments in our portfolio, we invest for 5, 7, 10 years, sometimes even longer. So really, when I think about options, there are not that many. And our shareholders within WAM alternative assets portfolio, they can overcome those challenges, and WMA makes it possible to access alternative investments. It's there are no illiquidity challenges, there are no minimum ticket size requirements, and at the same time, we construct a portfolio that is well diversified across various risks, across various asset classes.
Well, hello everybody, and thanks for taking the time to hear this presentation today. My name's Keith Cullen, and I am the founder and managing director of WT Financial Group Limited. So I'll start with a bit of a background on WT Financial Group for those of you that don't know us. We founded the business in 2010, initially under the name of Spring Financial Group, and our focus for the first 8 years of operation was a direct-to-consumer business with all salaried advisors providing financial advice to retail and wholesale clients. We built this into a sizable business from a zero start in 2010 to about $10 million worth of annual revenue, from 0 clients to about 3,000 clients across that point of time. We listed on the stock exchange in 2015, initially under the code of SFL, and had a very strong dividend history, paying out nearly $7 million in dividends. In 2018, in the wake of the Royal Commission, we took a decision to pivot the business from its direct-to-consumer focus because we saw an enormous opportunity in what is known as the dealer group space, or AFSL licensee space. All of the banks and a number of the institutions decided to exit the advice space in the wake of the Royal Commission. And so we saw this almost overnight unraveling of what had become a vertically integrated model. And we saw great opportunity in that. We set out to unlock the value out of the direct-to-consumer assets that we had built by providing access to those assets to independently owned financial advice businesses around the country. Across those few years from 2018, we have acquired a business known as Wealth Today. Then we followed it up with the acquisition of Sentry Group, and more recently in March this year, Synchron Group. To all of the advisors in these networks, which is now some 400 advice practices and around 600 advisors, we provide a comprehensive range of licensing, compliance, education, training and technical support, practice development, including marketing and consumer retention tools, and business development services to them. And we have now emerged as one of the largest financial advice groups in the country. In fact, we're third behind the 2 institutions that have remained in the space in AMP and Insignia. So we've built a very sizable operation, some 400 odd practices with around 600 advisors, $16 billion worth of funds under advice, $360 million of in-force insurance premiums, and around $25 million of new premium sales per annum. So a very sizable operation that we've managed to build in the space of just 3 years, having made that pivot to business as opposed to business to consumer. Across this same period of time, we've disposed of a number of our B2C assets. However, we have retained a practice within the business that's an integrated financial planning, tax and accounting and mortgage broking practice that still operates under the Spring Financial Group name. And this is a really important thing for us in so much as it enables us to keep connection with what it's like to deal with clients and sit in a room with clients every day and bring that real world practical experience to the table for the advice practices that we support. This all comes at a time, of course, when demand for advice continues to grow. So over the last 3 years, we've invested some $25 million in these acquisitions and restructuring our business. And the primary driver for this is we have seen demand for advice growing. We're right on the doorstep of the greatest intergenerational wealth transfer in history. We've got about $3.5 trillion about to pass from one generation to the next. We've got the largest cohort ever entering into aged care, and we've got superannuation contributions going up at a statutory rate, which is set to see a doubling of current superannuation assets by the end of this decade. We've got increased demand for estate and legacy planning, for retirement income advice, for that aged care advice that I mentioned. And of course, we've got the cohort that are going to be the recipients of this wealth transfer needing strategic investment advice. So demand is growing, yet supply has been contracting with the exit of those institutions from the space. Looking at what our key drivers to revenue are. So how we earn our revenue is, firstly, we collect all of the revenue that our advisors are generating through advice fees and insurance commissions. Each of the practices in the group pays us base fees, and then we retain a percentage of revenue that the advisors within the group are earning through those advice fees and insurance commissions. We've got licensing advisor services revenue as well. We've got a range of services we provide to our advisors on a user pays basis around helping them manage their risk and providing a variety of technology solutions and so on to them. We've still got our B2C revenue as well, albeit on a much smaller scale than what we had before we took this pivot into B2B. What's that look like from a revenue perspective? Well, we've just put our audited results for the year out. Our revenue was a little over $100 million for a GP of about $11 million. And we're very pleased with our EBITDA line of nearly $4 million, producing an underlying net profit before tax of $2.8 million and a statutory net profit before tax of $2.35 million, which was impacted by some restructuring costs that we had there in restructuring some debt on our acquisition of Synchron earlier this year. So a really pleasing result. What's most pleasing about it is that we have only completed our acquisition of Synchron in March. And so we had a $35 million contribution to revenue from just 3 months from Synchron, which has really put us in a good position for 2023. So we've got guidance in the market. You can see it there, 170 million going down to an EBITDA of 7 million and expecting a net profit before tax of 5 million for this year. So a really real change in the scale of our business. Board and management team, I won't bore you with too many details there, but you'll see it on the screen. Each of us has a very good experience in financial services. Our chairman, Guy Headley, our ex-Macquarie Bank, our non-exec director, Michael Harrison, ex-Shadforths, which was acquired by IOOF, and Chris Kalessis is my co-founder in the business and very experienced in financial services. Importantly, board and management are very aligned with shareholders. We have around 33% of the company shared between board and management. And then we have some very strong experienced financial services shareholders in there in UIL Limited, which is a UK-listed investment company, Glen & Small Companies, and IFM and also Ariadne on the register. So a really good team of shareholders, both institutional and also board and management, supporting this strategy in building the dealer group out.
Hello, my name is Michael Ivanchenko. I'm the Chief Executive Officer of Kinetico, a Know Your People and Compliance Made Simple solutions company with a vision and mission about powering insights for better, safer workplaces. I'd like to begin by paying my respects to the Indigenous custodians of this land and pay my respects to their elders past, present and emerging as I speak to you today from Gadigal country of the Eora Nation. A bit of history about CV Check. CV Check, now known as Kinetico, was founded almost 17 years ago, and was Australia's first digital background screening and police check business, and has progressively grown its reach and its capability throughout that time, learning along the way, growing revenue along the way to where we find ourselves today, with being an end-to-end provider of solutions in RegTech to maintain full workforce compliance at all times, with visibility for organisations to make sure that they are in control of their processes and their needs, and empowering their workers to own their data and remain in control of their data at all times. Our mission is, as I mentioned, to power insights for better, safer workplaces. It's not just about capturing data or storing data, it's about putting it in context, making sure that the reasons that regulatory requirements or compliance processes exist are actually followed. It's not a box ticking exercise. These things matter. Knowing that the medical professional dealing with you is properly qualified, it's properly up to date with all the training, knowing that the process of being followed at a work site to maintain safety for all workers and customers is important. And we know that empowering the role, the value we play for organisations is making sure that this is done in a simple, unobtrusive way. With ever increasing requirements around regulation and compliance, it's very easy for these to start to become either onerous or, for that matter, expensive for organisations and get in the way of why those businesses exist in the first place. Our vision is to make sure that organisations are freed to focus on opportunities in their core business, and first and foremost, where data is trusted. If we don't have trust and validity in information in a digital economy, you cannot have a digital economy. So for us, helping organisations to know their people and ensure 100% compliance in real time, simply, and simply is the key word. A bit about our product suite. So key reason why we have renamed the group to Kinetico is that we are so much more than our very successful background screening and credential validation business in CV Check. So CV Check is Australia and New Zealand's premier screening brand in all kinds of screening, primarily at pre-employment for businesses and organisations, and external credential validation. We then have our digital credential passport, allowing not only for workers to store, own and control their information, but also to share it with organisations as they need to prove their credentials or provide the required information, but then do so in a secure way. On-site becomes the user experience for workers in interacting with all of our products. So not only is there a security and a trust element, it makes it much simpler, and as I say, they control their information. Cited is our cloud-based automated real-time compliance monitoring and management solution. This is about putting credentials and compliance in context. It is not enough to simply have the information, store it in a filing cabinet, and then recall it later on when you're going through an audit or having to deal with some kind of incident or issue. Our solutions are about giving organisations real-time visibility and assurance and trust that the requirements they have to maintain compliance day in, day out are actually being followed, and that they can easily perform those tasks, and it doesn't become an overhead to day-to-day operations. And then we also have a logistics and workforce management product, which is very successful primarily in the mining and industrial sector in terms of worker mobilisation and ensuring that when you actually manage the logistics of deploying your workforce, they are also compliant in doing that in the first place. You don't want to be turning up and having a worker turn up at a mine site ready to deploy at the cost of travel, at the cost of organising accommodation, to find out their drilling certificate is not current and therefore not able to be deployed. A little bit about our performance. So over the last year, we grew revenue 51% to $26.4 million. In Q1, we're up a further 9%, $6.9 million revenue for Q1. That was our 9th consecutive quarter of positive operating cash flow, which over last year was $3.1 million. 80% of our customers are repeat customers, and we have over 10,000 corporate customers in Australia and New Zealand. We're an organisation with 0 debt and $11 million cash in the bank. We're in a position where we are funding our own growth. We are a tech company that is cash flow positive, cash flow from operating positive, and we continue to grow and enhance our product offering in a sector that is increasingly relevant, increasingly necessary, and at the forefront of organisational thinking. Major growth we've also seen across our products is our SaaS revenue growth, $2.4 million last year, up from $600,000 in the prior corresponding year. And already in Q1, we've seen that jump, and we expect that trend to continue in coming quarters. It's a little bit about just on what I mean by compliance and obviously why it's so important. Compliance starts right at the beginning of validating a worker or anybody coming into an organisation. It could be from a third-party contractor for that matter. And that is the full range of pre-employment checks or recurring qualifications needed to be done if your annual driver's licence, for instance, but it may be something like your drilling licence, and a mine site needs to be renewed much more frequently. It may be in any other industry, a legal profession, demonstrating your hours of training and refresher courses are being met. So right across all sectors and all industry components, there is a need around those recurring checks. We then have the on-demand and policy confirmation that actually occur. So whether you've got your induction to site, whether you've got quarterly cyber security or phishing training around various types of cyber security or confirmation of anti-harassment policy, these are all things that get captured by the system, validated, and what's more, can be done via the on-site application to make sure that it is unobtrusive, quick and easy and out of the way. And then of course you have the final piece of daily business compliance, whatever the practice and policies and confirmations that an organisation has in place to ensure that they are compliant at all times. Our platform actually allows organisations to have those requirements entered and tracked via the on-site application so that they are captured in real time. You've got the information therefore visible, and before an incident occurs, confirmation from the actual individual that they have performed the required procedural process. This is all about managing compliance before issues occur. So Kinetico, certainty every day, all about providing end-to-end real-time workforce compliance, whether it is starting from pre-employment and background.
Justin Werner here, Managing Director of Nickel Industries Limited. We're an ASX 200 company. We have established operating footprints in what are now 2 of the world's largest nickel production centres in Indonesia on 2 islands, Sulawesi and also Halmahera. Indonesia is forecast to produce 60% of global nickel supply by 2025. And we have footprints, as I said, in 2 of the world's largest industrial parks, producing significant low-cost nickel units for the stainless steel. And we've just more recently now transitioned into the battery EV market. On this slide here, you can see an overview of the 2 industrial parks that we operate in. On the left is what's called Indonesia Morowali Industrial Park, or IMIP. That's the world's largest fully vertically integrated stainless steel park. Has capacity for 3 to 4 million tonnes of stainless per annum. Currently has 44 operating RKEF lines, which is rotary kiln electric furnace, with a further 8 under construction. We have, of those 44 operating lines, we have 4 lines that are in operation, And of the 8 under construction, we have another 4 that are under construction. So it will take our operations to 8 RKEF lines within IMIP. In terms of employees, it employs 45,000 people. 40,000 of those are locals. It has 3 gigawatt of captive power. And also more recently has just commissioned 2 high pressure acid leach plants, which produce a mixed hydroxide precipitate, which is very applicable for the EV battery market and can be upgraded into nickel and cobalt sulfate. We also have an interest in a high grade large tonnage mine, which is about 12 to 15 kilometres from the industrial park. And we supply both high grade saprolite ore and limonite ore to the RKEF and HPAL operations within the IMIP. If you look on the right there, Indonesia Weda Bay Industrial Park, which is basically on the neighbouring island, really just a carbon copy of IMIP, other than at this point there is no plans for any stainless steel capacity. Again, very large, 35,000 employees. Across these industrial parks, there's been almost US 20 billion invested, and as I've said, 2 of the largest stainless steel and NPI and nickel production centres globally. Really some world-class operations. We've just undergone and are coming towards the finalisation of a tremendous ramp-up. If you look at this chart here, you can see last year our attributable nickel metal production was 32,000 tonnes. We just recently commissioned 4 more RKEF lines called Angel Nickel, or ANI, and you can see the next green bar, which is 70,000 tonnes. That's our attributable nickel metal production currently on an annualised basis. We have 4 more RKEF lines called Oracle Nickel, or ONI, which come online. Our first line is commissioning at this point in time. That should be fully ramped up next year. That will take our attributable nickel metal production to in excess of 100,000 tonnes on an annual basis. We've been listed only a little more than 3 years, so tremendous growth profile. If you look at some of the others that we've leapfrogged over, BHP, Eramet, Sumitomo, I mean, some of these guys have been in nickel for 40 plus years. We've been able to achieve this through our relationship with Tsingshan, who's the world's largest stainless steel producer. They built and operate the 2 industrial parks that we just looked at. They're our largest shareholder. And what's attractive of working together with Tsingshan is all of the nickel capacity that we've built with them comes with a capex guarantee, a nameplate guarantee, and a time frame guarantee. And in all instances, they operate successfully at sort of 130% above nameplate. And so, look, we'd like to think that, the business is about as de-risked as you can see a business. It's also an industrial business. These RKEF lines don't rely on ore from our particular mine. They, in fact, source ore from all over the archipelago. And so, as a result of that, and the fact that we have very little sustaining capex, unlike a traditional mining company, taking the case of an underground mining company, which would have significant ongoing sustaining capex for mine development. We are talking about sustaining capex in our business of only a couple of $1 million every couple of years to reline the kilns and the furnace with refractory bricks. We're also the beneficiary of, for 4 of our RKEF lines, a 7-year tax holiday at 0 tax, and our new 8 lines at 10 years of 0 tax. That allows us to free up a lot of cash that we can reinvest into growing the business and also return money to shareholders. So we are a material dividend payer. We paid 4 cents Australian last year, and we've already paid an interim dividend this year of Australian 2 cents. So just finally, as I said, we're in the midst of a ramp up. If you look at our production last year from 4 RKEF lines, and these RKEF lines are older and have a 20% less capacity than our next 8 RKEF lines, 4 of which are ramped up, the other 4 which are commissioning. Our EBITDA last year was US 225 million from our existing 4 RKEF lines. We're now moving to 12 RKEF lines, and those additional lines have a 20% greater capacity. We would expect to sort of, at least triple that current EBITDA. So you can take those numbers and depending on what the margin is, you can see the size of the business and the cash flows that we'll be generating. All of this growth is paid for. It's locked in, as I said, comes with a CapEx guarantee. It's about as risk-free as you can see. So it's an exciting time for the company. I would just finish on the note that we've actually converted 2 of our RKEF lines into the production of nickel matte. Nickel matte is what's called a Class 1 nickel product, and that has direct exposure to the LME Shanghai futures pricing and is applicable to be used within the EV battery market. And we are looking to grow our nickel units and exposure to that Class 1 EV battery market. And that will make us a truly diversified and probably the only listed global listed nickel producer that has exposure to not just the Class 2 nickel market, which is typically nickel pig iron for the stainless steel industry in China, but also for that Class 1 battery market, which is obviously experiencing considerable growth year on year as the penetration of EV vehicles continues to grow. The Hengjaya mine, which is the next slide, not only do we have a very robust industrial operation, but we're underpinned by our Hengjaya mine, which was our foundation asset, has 3.7 million tonnes of contained nickel metal, places us up amongst top 10 global known resources for nickel. So we're sitting on very large nickel resources, and that number will continue to grow. Finally, we released our quarterly result, over 20,000 tonnes of nickel metal production for the quarter, which was a record. Over cash generation from operations of $54 million or $55 million. Not our strongest quarter, as we experienced some margin contraction, but pleasingly our costs are continuing to trend down. NPI prices, we're now seeing a trend back up again. And so we expect to move back into the sort of margins that we were generating of sort of $4,000 to $5,000 a tonne. And in fact, last quarter, our June quarter, was a record quarter where we generated over $100 million in EBITDA. And finally, our mine had a record quarter as well for the September quarter of close to 1.7 million tonnes of ore that was sold. So look, in closing, Nickel Industries is the largest nickel producer, pure nickel producer on the ASX. We continue to grow. We have very strong industrial style margins, but we're underpinned by a world-class global nickel resource, which is obviously very important. And we're now transitioning and making that move into the Class 1 EV battery market. I would just end also on a sustainability perspective. Pleased to announce that during the quarter, we won a number of awards, achieved ISO accreditation. We've won awards for best mine site rehabilitation. We produce an annual sustainability report. We are now in the process of implementing 440 megawatt peak of solar, and we will continue to grow that. So thank you for your time.
Hi, so my name's Stuart Dixon. I'm the Managing Director and CEO of Rismine Mines. Rismine Mines is an ASX-listed mineral resource and exploration company, and predominantly our focus is on reigniting zinc production in northern Spain. So the Nevada-Zulias project is proximal to the world-class Rio Sin mine, which closed in 2003, having formerly been operated by Xstrata. This world-class deposit of 62 million tonnes, around 7% zinc and 1% lead, is just 9 kilometres from the San Jose mine, which is the centrepiece of our project in northern Spain in Cantabria. We also benefit from being extremely close to the San Juan smelter, which is operated by Glencore, which is the world's second largest zinc smelter, and that's 100 kilometres from the San Jose mine by sealed A8 highway. So zinc is a critical raw material and has been designated as a metal which is essential to our energy transition that we all go through today. It's extremely important in its application for solar panels, where demand for that application is expected to double by 2040. It also has the use of its anti-corrosive properties across wind turbines, and more importantly and excitingly, is an emerging metal in batteries and also energy storage. So zinc is right at the heart of the energy transition story, and we're pleased to play our role in that. As a former producing mining area, we also benefit from a large amount of infrastructure being in place. So we have significant mine development already conducted. We have power, water, and other amenities at the site. All of that confers a significant cost and time advantage on the company. So what's our strategy? Our strategy is very clear. It has always been to bring San Jose back into production, to explore the opportunity for small scale production. This in turn would allow us to sustainably finance the second limb of our strategy, which is building up a sizable resource over the tenement area. And I'm pleased to say that we've advanced significantly on both of those strands of our strategy. One, we've had multiple discoveries at the San Jose mine, in particular lower lying lenses. Been pleased to report extremely high grade and sizable widths of zinc intersections at the San Jose mine, and also to define a substantial JORC exploration target over the wider exploration area surrounding the San Jose mine. So what's next? We're currently drilling and have been conducting a surface drilling campaign over the exploration tenement area called Buena Hora, and that is due to complete shortly, where we look forward to reporting the results from that. At the same time, we'll be moving the rig back to San Jose to support the first limb of our strategy, which is to follow up the successful drilling we've already had there to date. All of this is to support the studies which we'll be conducting to evaluate small-scale production restart opportunities at the San Jose mine. So we have lots of news flow to come, both from surface drilling, underground drilling, all the exploratory work we've done at Buena Hora, but also the studies which will allow us to really get a sense of the scale and the opportunity that we have to bring San Jose mine back into production.
Good afternoon. Great to be here. Thanks to the TCN team. Really excited to introduce Pan-Asian Metals to Emerging Gems. My name is Paul Locke. I'm the Chairman and Managing Director of the company. And what I'd like to do is tell you a little bit about what we do, where we're going, what our objectives are. Please observe the disclaimer here, and you can always go to the ASX platform to see all of our releases which relate to this presentation. We have a market cap of about 60 million. We have $3.4 million cash on board. We have 147 million shares out the door. We don't have any options, warrants or convertible notes. And management has around 50% of the company. This is really important. We're one of the few companies on the ASX and elsewhere where management has a lot of skin in the game. The board has 5 members, 2 executive directors and 3 non-executive directors. David Hobby and myself are executive directors. I'm a project financier. I have a lot of experience in mining projects and funding mining projects. David Hobby is an economic geologist. He has a lot of experience in identifying opportunities and working up the opportunities to a point where we can determine whether they're economic or not. The non-executive directors comprise David Doherty. He's been involved in Thailand since the mid-80s. Thanasak Chaniaphoon, a Thai national, a lawyer, very well respected in the business and government communities. Supriya Sen, she's had experience in project finance with the World Bank, Asia Development Bank, Citibank, and most recently she was a senior advisor with McKinsey & Co, where she focused on environmental and ESG solutions. What do? We have 3 projects. The Rionket project is our lead project. It's about 40 minutes out of Phuket. The Katatong project is a series of 5 applications a bit further north, and the Khao Soon tungsten project is one of the leading tungsten projects in the world, and that's a couple of hours to the east. This is a fantastic jurisdiction and a fantastic region. We have 3 international airports in close proximity. We have major roads passing our projects. We have hydropower stations, but we're in sparsely populated rural areas. These are old mining areas and the people understand what mining is, so we're welcome. We see a lot of opportunity here to develop these projects and deliver a product into the Eastern Economic Corridor, a highly industrialised area just out of Bangkok. Onto the projects. The Rionket project is our lead project, and you can see that there are two prospects here. The Rionket lithium prospect to the south, which we're focusing on right at the moment. We've been drilling this since early 2021. We have a 10.4 million tonne resource grading 0.44% Li2O, and then we've got the Bangi Tum prospect to the north. This has a drill supported exploration target of 8 to 14 million tonnes grading 0.5 to 0.8% Li2O, and just recently we delivered a expanded footprint based on geochemical work which increased our target area by 200%. At Rionket, the initial resource was based on holes 1 to 46. We've been doing infill and extensional drilling, and we just closed off on hole 94, and we expect to report an upgraded resource early in the new year. This is a lepidolite style project. Lepidolite is one of the cheapest sources of lithium. It might be lower grade, but it's cheaper to process. And this is the big opportunity here. We are based in a very low cost but highly industrialized environment. We've got a low cost source of product, and we're delivering into the auto sector, which is close by. Here we can see the Bangi Tum prospect, and I spoke of some recent geochemical work. You can see in this chart here two rock chips or two rock samples which were recently assayed, and they're both above 2%. In fact, of 64 rock chip and channel assays, 44 averaged about 1.57% Li2O. 12 were above 2%. We had the highest grade of 2.62% Li2O, and 33 were above 1%. This geochemical work identified an area which was 200% the size of that which we defined our exploration target on. We're extremely excited about Bangi Tum. It's going to complement Rionket, where we've got a 10.4 million tonne JORC resource, and we're just completing drilling to expand it. The Catatong project is a series of 5 applications. You can see here 2 application areas have geothermal fields in them, and 4 of the 5 have hard rock, lithium and tin. Both Catatong and Rionket are on the grid and connected to a hydro power station, but there's also the opportunity to deliver solar. So we expect to be producing a very low carbon footprint product. We're extremely excited about Catatong. There's a lot of opportunity for this project to complement both the Rionket and Bangi Tum prospects. You can see on this slide, this is the Carsoon Tungsten project. There's over 12 kilometres of strike. There's 10 target prospects. We produced a 15 to 29 million tonne exploration target grading 0.2 to 0.4% WO3 based on those 4 drilled prospects, so it's drill supported. We're just finishing metallurgical work now, and then that'll determine our next steps. So why Thailand? Many people ask this. Thailand is the 25th most complex industrial economy on the globe. Thailand is the largest auto producer in Southeast Asia and the 4th largest in Asia. So what we see here is an advanced industrial economy, one of the leading auto producers in Asia. EV production has already started there. Geely, BYD, Great Wall have started or are about to start EV production there. The Mercedes EQS will be produced there. Right now there are 18 EV projects on the books, and there are 14 battery projects on the books. We're the only lithium explorer in Southeast Asia, and definitely the only lithium explorer and developer in Thailand. This means we're well positioned to move downstream, evaluate our product, producing lithium carbonate, and hopefully we can position ourselves to joint venture and produce advanced chemicals for battery production. This is our objective, and I think we'll get there. One of the most interesting things about Southeast Asia is that it's not being focused on by the global lithium explorers. If you look at the peer group on the ASX and even the TSX, their focus is North America and the Inflation Reduction Act, or Europe. Not one of them is focusing on Asia and the opportunities there. When you look at this chart, you'll see that there are 4 areas where EV or battery production has begun or is about to begin. In Vietnam, we've got VinFast producing both electric vehicles and batteries. In Malaysia, EV Group, a mid-tier battery producer out of China, just committed to building a battery plant in Malaysia to service the power tool market and the 2- and 3-wheeler markets in Asia. In India, there's about 10 Indian companies which are producing EVs. Mahindra, a brand name which not many people know of, was producing EVs in 2001. There are 10 auto companies focusing on EVs there, and there are about 10 companies focusing on the 2- and 3-wheeler market. India and Southeast Asia, or India and ASEAN, represents 2 billion people, and about 500 million are merging into the middle class. They want to do their thing for the global environment. They want 2-wheelers or 3-wheelers, which are electric, or electric cars. This is a massive opportunity. And with this in mind, we also need to understand that Pan Asia Metals is the only lithium project owner and developer in the region. Now, what we're trying to show in this map is that we've got a lot of concentration of projects and concentration of geography. And when we look at project financiers, there's not a lot of balance sheet to go around. And what banks don't like is geographic concentration and commodity concentration. So our view is that in these 5 lithium areas, the lead projects or the first projects will get financed, but the bank's balance sheets will run out of power. So that financing will become more difficult. So our view is funding will be more easily sourced because we're the only lithium explorer developer in the region with advanced lithium projects, and we've got a lot of capital looking for opportunities. Now, where are we taking this company? What do we want to do? Let me tell you. We want to move past the mine gate and deliver an advanced lithium product or advanced lithium chemical products. Many of our peers won't be able to move past the mine gate. They'll deliver a concentrate. There's absolutely nothing wrong with this. It can be highly profitable, and in this market it is highly profitable. But what we're doing is setting ourselves up to move downstream. We want to produce lithium chemicals, and then we want to use those lithium chemicals to move into a joint venture with a knowledge partner to produce cathode active materials. This is a doable opportunity, and in fact we've had high-level discussions where this sort of concept is agreeable. So our objective is to move away from the mine gate, away from the volatility of the commodity cycle, downstream where we get remarked as an industrial company, our margins become steadier, and also we get exposure to a lot of new opportunities and options to explore new opportunities. That's our objective here. And of course, all of this is a waste of time if you don't have sustainability, your community and the environment at front of mind. We're very focused on delivering a great outcome for all stakeholders. We've been following the UN's SDGs. We've put a stake in the ground. We're a small company, but we want to start with quality education, gender equality, and also focusing on where we source our inputs and what our outputs are. They've got to be as carbon neutral as possible and sustainable. So our focus is to bring our community along with us. What all this means is that when we go for licensing, we have our community on side. They support us. They see the opportunities that our company can bring and what we can deliver. So to finish off, 5 key points on why to invest. Point 1, we're the only lithium explorer in Southeast Asia with advanced lithium projects. We are positioned uniquely to deliver into the rapidly emerging Thai electric vehicle and lithium-ion battery supply chain. Point 2, we're in a very low-cost environment in an advanced industrial economy. Point 3, strong metallurgy supports our project's encouraging fundamentals. Point 4, Thailand will be the largest EV and LIB producer in Southeast Asia, without a doubt. Point 5, we've got a very tight and well-maintained capital structure, and management is aligned with shareholders. We have skin in the game. Thanks for listening to me. I hope you enjoy our story. Get on board. We've got a big future, and we look forward to delivering some great outcomes in the near future. Thank you.
Morning. My name is Arvind Misra. I'm Managing Director of Belarox. Belarox is a company which was listed on the stock exchange in January this year. We own a couple of projects, one in New South Wales, one in WA. The project in New South Wales is our flagship project. This project was previously owned by other company, Ironbark. The ASX code is IBZ. Previous to them, it was owned by various other owners, including Rio Tinto. And also historically, there was an underground mine at Belarox, which mined very high-grade copper and gold and silver. So based upon the holes that were drilled by previous owners, they had published a JORC 2004 compliant resource. So we are a company that is a bit more advanced than average exploration companies starting from scratch, because we already have a lot of holes drilled, historical information, and a JORC resource. In terms of the location of the project, our project is located about 300 kilometers northwest of Sydney. It falls into the famous belt called Lachlan Fold Belt. And we have about 643 square kilometer area. And the nearest town or well-established towns are Muzzy, Orange, and Dubbo. So it's very well-serviced project area for us. The targets that we have, they're only shallow at the moment, only up to 350 and 400 meters of depth. My second project is in Western Australia, near Coolgardie, about 30 kilometers west of Coolgardie, and it is very near to some of the very large, well-established projects like Bullabulling, 3 million ounces, owned by another company, and north of our leases is another project called Gecko, which has got 320,000 ounces, and Bullabulling has got 3 million ounces in resource. So it happens to be in that area, which is known for very high level of gold endowment in that area. Very excited about the work. The work at Bullabulling that we have done is 2D and 3D prospectivity modeling. We have got 7 targets defined, and we'll be drilling them sometime early next year. But our flagship project is the Belarox project. We have finished phase 1 drilling there, drilling about 5,700 meters of drilling. So inclusive of the holes, that were 27 holes drilled by previous owners and about 33 holes. So the new model that we are generating for the resource estimation has got about 60 hole information going into it. And we are looking at announcing a resource estimate hopefully by end of October. So this work that we have completed since listing in January has been so quite significant work and all very successful program. So we've done gravity survey, we've done IP survey, we have done downhole survey, and inclusive of the magnetic survey done in the past, we have done a prospectivity modeling, and prospectivity modeling shows the extensions of the ore body, particularly in the area south of our second project called Native B, that goes for 1.5 kilometers south. And in the next round of drilling that we expect to do would be to drill Native B and also test the depth extensions of the Belarox. So we got very exciting next round of drilling program, which is we're going to pursue now on the back of a very successful capital raise we did. Last week we announced $3.85 million at 55 cent share price, and it was very well supported because the offer was subscribed within a few hours of opening on the first day of trading halt. So well-funded company, very tightly held register. 20% of our shareholding is about 60%. Top 20 holds about 60% of shareholding, very tightly held. We got great support from some key brokers, including Kinetico and CPS and Lost Partners. In addition to this great project, we have got good team led by our chairman Neil Warburton and very famous geologist Michelle Stokes, and a couple of independent non-executive directors, Simon Robertson and also John Tracus. They both are very experienced ASX directors. In terms of what's coming up in the next 12 months, in the month of October, we're going to be announcing metallurgy. We'll be announcing our maiden resource, and then we will get on with the second phase of drilling, which we expect to start second half of November. And then we'll do a bit more geology and reconnaissance work, early stage work. Further beyond the 6 kilometers we have only studied so far, we got 20 more kilometers beyond that, which is mineralized, trained. And that's on our Belarox project. On the below-bulling side, we'll be drilling some holes, and we will be assessing the results of that and further doing the modeling. And beyond that, we have 2 more leases that are about to be granted to us on the eastern side, 2 ELAs, and those ELAs they have got very promising signs of gold. There has been some old gold working in that area, and nobody knows where the source is. So we'll be looking at doing some work in that area also. So our exploration strategy is centered around developing a JORC 2012 inferred resource over the historic mines at Belarox and NTB. We will explore the potential extension and repetitions of massive sulfide mineralization defined by electrical geophysics techniques. The 3D geological models will be developed using artificial intelligence, assisted computer modeling techniques to prioritize the new targets. And obviously, with the success, we have been one of the most successful IPO of this year. Based on their success, I have been having a lot of offers to acquire the projects which are nearby to us in the similar commodities, and we keep looking at them. And if they become value accretive for us, we'll be going and looking at doing some M&A work. So in summary, very good market response to us since we listed in January 2022. We're on track to deliver a resource. Multiple drill holes that we have drilled have intersected massive sulfide, and several of them have been wider intersection and higher in grade. And new drill ready targets are ready that we know we can drill and hopefully intersect similar mineralization to Belarox. And at Bullabulling, we'll be doing our drilling. We are a well-funded company, very good trade register, very good team, delivering the results as we promised. And we're looking forward to building our business going forward.
Well, hello, everyone. Thanks for listening and listening about DigitalX. So DigitalX, I am the CEO, I am Lisa Wade, and DigitalX is a digital investment management company that operates in both the new world of crypto and digital assets, and a catchphrase we commonly call Web3. And we also run some traditional finance businesses. And what we really do is we operate at the intersection of finance and technology and build great investment products and great investment services inside of the intersection of finance and technology. So what I wanted to talk to you about today is a little bit about, who our company is and our structure. So we run sort of 2 parts to the business. The first is a crypto investment management firm where we have 2 main funds. We have a Bitcoin fund and we have a top 20 crypto fund. The Bitcoin fund is an access product. So if you're interested in and curious about Bitcoin, but you don't want to open a wallet, all of those things, we manage that for you, which is actually very highly technical and quite complex, even though a single asset seems like a simple strategy, and not to mention highly risky. And then we run a crypto fund where what we would say is not all crypto is created equal. And we start with an investment universe of 19,000 tokens approximately, or 90,000 tokens that are out there. And we filter all the way down to doing research on the top 100. And then from the top 100 or emerging tokens that we believe will come into the top 20, we then build our portfolio around companies that we believe will be the top 20 of the future or are in the top 20 now. Now, when I'm talking about those funds, they're wholesale funds, so you have to qualify as a wholesale investor to be able to invest in them. Then within that business, we're also releasing a new fund, which is a real world asset tokenization fund. And I don't want to get super geeky about Web3 because it's a very high level talk. However, when you talk about what everybody's calling the transition to the Web3 economy or the transition to the programmable economy, what we're really talking about is in Web 2, you shop online on your couch with a credit card by yourself. In Web 3, you go into a store in the metaverse and you pay through tokens, which creates this thing called atomic settlement. That's what we're really calling the financial rails of Web 3. In that, you will be able to create digital representations of real world assets. And that's where we really see the enormous opportunity of Web3. So we're building a real world asset tokenization fund to take advantage of that thematic alone and give people the opportunity and access to invest in tokenized real world assets. Next to that, we also have a Bitcoin balance sheet. So we're OG in Bitcoin. We're the only Australian listed company to have Bitcoin on our balance sheet. And to generate more returns for shareholders, which is obviously our primary focus as a business, is to generate returns for shareholders. We also do ETH staking, and we run an Australian ETH staking node, well, 4 nodes to be precise. And we also generate yields for our investors by doing that. Now, the second half of our business, I think, is really cool. It's a one-off share trading business called Sell My Shares. And say, for example, you inherit shares, or you get given some shares at work and you don't know how to sell them. You just come onto our website, give us your HIN, we check who you are, and then you sell your shares. Through this, we've also have an innovation, which we've done a world first this year, of settling those shares in what we call T0 as an internal nickname, or same-day settlement. So basically, you can sell your shares and receive the money the same day. Normally, you may or may not know that when you sell shares, you don't get the money for a couple of days. We also have a RegTech product called Drawbridge. So if you work yourself for a listed company, Drawbridge is a compliance tool that sits on the blockchain in partnership with the ASX and Symphony, their blockchain platform. And it basically stops you from insider trading, just in case there's stuff going on at your company that means that you might be perceived to be in a blackout when you don't know that you're in a blackout. So it's a RegTech and compliance tool. Now, in terms of what does this look like for the future of DigitalX and how are we growing the business? So we have some key revenue drivers, and those I would like to just really point out that we are very focused in what we do, and our key revenue drivers sit around maximizing the revenue in those businesses, not just running off and doing 50 or 100 new things, which is really easy to do in our space when we are an innovation company. We've got a development team, we're doing all the cool things and building all the cool things, but what we're doing is we're really focusing on the customers that we have, the customers of Sell My Shares, and building tools that maximize their experience into Web3. So our key revenue drivers going forward are to develop and to fund the T0, or the same-day settlement service, potentially across other types of assets, but really focusing on partnering with larger organizations who may want to offer that service to their staff. When I talked about inheriting shares, there's a big market for Sell My Shares in engaging with deceased estates lawyers, and really that's a marketing activity. So we're focusing on that. And within our funds business, we're focusing on partnerships to increase our funds under management, which then plays into the ETH staking becoming a revenue opportunity both for the balance sheet and for our customers. So that's who we are in a nutshell. I'm happy to answer any questions. There's some details in the pack on how to reach out to us. I really believe that we're a great little Aussie gem of a company. In fact, I'm a new CEO. I took this role in February, and the way I described DigitalX to the board is a rough diamond that we need to polish, and I really see my job as polishing that rough diamond. So I don't know how many of the little gems are actually diamonds, but we're a very cool diamond. So I hope you get to know our company, and thank you very much.
Hello everyone, my name is Sean De Gregorio. I'm the CEO and founder of Frontier Digital Ventures. Frontier Digital Ventures started in 2014. It started with the idea of investing in online classifieds businesses in emerging markets. My background prior to 2014 had been running online classifieds businesses in emerging markets in Southeast Asia and other regions. And prior to that, I'd been with the REA group. So my background very much in online classifieds. And in 2014, we started to look at opportunities to invest in similar businesses, online property portals, online automotive portals, in more emerging markets around the world. We listed the business in 2016, and over the course of that time have built a portfolio of market-leading classifieds businesses. that are now grouped in 3 key regions for us. We have a group of businesses in Latin America, which we refer to as FDV Latam. They're all market leaders. They're in online property, they're in online automotive businesses and some horizontals. LATAM is a significant part of the world for us in terms of our presence. We have a presence in Asia, FDV Asia, where we have another group of businesses, again, all property portals and automotive portals, and all market leaders. Similarly, FDV MENA, group of businesses there, growing that group of businesses, and again, same types of businesses and all market leaders in their category. So if people are familiar with online classifieds, they'll be familiar with the realestate.coms and the car sales of the world. We're running those businesses in emerging markets. We typically partner with local entrepreneurs. We invest as a minority when they're starting the business, and over time, we seek to buy more of the business from the founders, adding our expertise along the way until we own 100% and consequently fully control the businesses. Our revenues, you can see on the slide there that I'm talking to, large businesses I mentioned in LATAM, large business in Asia, and a growing business in MENA. We're based out of Kuala Lumpur and are able to run these businesses effectively in combination with really strong local management teams who are on the ground and executing. So we're a very local country first structure. We're all about the local brands in each of those markets, and we support them with a small team based in Kuala Lumpur who have a long history in running these businesses successfully. So we've gone from essentially nothing a number of years ago to now having one of the largest portfolios of classifieds businesses in emerging markets. In terms of our business model, again, if you're familiar with the classifieds model, you'll understand our businesses really easily. If I use, for example, online property portals, when we were building our portfolio, we would go and look for early stage property portals in emerging markets. We avoid really large competitive emerging markets like Brazil or China or India, and tend to go to markets where there's less competition. It's far easier to be the market leader, and we can invest at a much more modest valuation and create a whole lot more value by being a market leader in some significant emerging markets. So really is founded around locally run businesses, startups that we can identify, that we can invest in. Over time, we will work with the founders, often leaving them in operational control of the business while we start to apply our expertise and help, and really some key goals of strengthening market leadership, because you want to dominate these markets. Working together with the local team to achieve that. And then, of course, as the business starts to grow, as the business starts to become more stable, as the business becomes a clear market leader, the reliance on the local entrepreneur is less. And that's at a point where we like to increase our ownership of the business. So we'll generally start as a minority, work with the founders, build out the business, become a market leader, and then we like to try and acquire the rest of the business from the founder, and then exercise full control and make the most of the work that's been done in creating a market leader and the competitive advantage that that provides and the value that can be created around the business. Interestingly, with our model, it's always been predicated on ad spend. So we're generating ad dollars from car dealers, from property agents in emerging markets. Moreover, though, in recent times, in emerging markets, the opportunity to do much more than just be an advertising business has become real. And many of our businesses are now helping consumers not just search for a house or a car in one of our countries or one of our markets, but continue right through past the discovery process, connecting them with the seller and assisting them through the entirety of the transaction. So this is a strategic benefit that you have as a market leader. You can take what is a classifieds business, build on the foundation and the strength of that classifieds leadership, but be able to assist consumers much further than just search and discovery, right through the transaction and work much more closely with the buyer and the seller and generate fees from the transaction. So all of our strategic strength is based around our classifieds leadership in these markets, but the value and the opportunity that we see is to do so much more than just stop at search and discover, but help consumers and sellers, buyers and sellers, connect and complete the transaction and consequently generate fees from the transactions of houses and cars in emerging markets. Just to take you through some highlights and some key data points of our company, we recently released our Q3 results, our quarterly activity report, and we're a business that has really been focused on growth, on revenue growth. We started with essentially no revenue just a number of years ago, and we're now, hitting to quarterly run rates of 20+ million. So really focused on revenue growth. That's the big opportunity in our markets. But what we've also always said is we want to run sustainable businesses, and that means our business is becoming profitable. So for the first time in Q3, all of our regions, LATAM, MENA, and Asia, were profitable. That hasn't happened before. It's a big moment in the evolution of our portfolio and our companies and our business. So a really key data point for us is big focus on growth historically. We will continue to focus on revenue growth, but we're now reaching the point, a tipping point where we're profitable. Our companies are becoming profitable and we're generating positive EBITDA at an operating level for our companies, and consequently cash flow follows that. So significant achievement in the third quarter of this year. Long history of revenue growth, will continue to grow revenue, but our companies are now becoming profitable. Our regions are profitable, and that's a significant outcome for FDV and of course our shareholders. Our aim, of course, is to continue to increase not only revenue growth, but our operating margin. And we did that in Q3. In dollar terms, we doubled. In percentage terms, we increased our operating margin, and all the while retain a really healthy cash balance. So if you look at the key performance data points for us, it's revenue growth, it's profitability, it's heading toward cash flow break even, and it's having a really strong balance sheet, running market leaders with tremendous amounts of growth ahead in markets where we're clear leaders. We recently also announced the continued evolution of our structure. So our three regions, LATAM, Asia, and MENA, we've now appointed a local CEO to run our FDV LATAM business. We've been running these businesses from our head office in Kuala Lumpur. We've always said that we wanted to run them locally, so that's a significant step in the direction of better management of our regions. We've also set an ambition for FDV LATAM to be, whilst autonomously managed locally, to also explore the potential to list on the NASDAQ exchange as an aspiration for that business. So we recognize that our job is to run really good businesses that grow revenue, that are profitable, that generate cash, and then explore ways to maximize the value for our shareholders in what's being created. So we're exploring that option. It's a great set of businesses in LATAM, and it's a certain catalyst for the value that we're building here in these businesses. Equally, we continue to look at our MENA group of companies, our Asia group of companies, and ways in which we can maximize the value that we think is sitting within those companies that perhaps is not clearly being realized with our current structure. So all of those things from a strategic point of view continue to be options for us. But meanwhile, we'll continue to run great market-leading businesses, growing businesses profitably in our key regions. Thank you.
Max Canfield, so I've recently joined Glennon Capital. So we're a small caps manager, managing GC1, which is the listed investment company.
What do you believe are the biggest emerging trends that are going to impact 2023?
Yeah, so obviously we saw the RBA go up another 25 basis points yesterday. But it's really going to be the delayed impact of fixed rates rolling onto variable. So historically, the domestic population has preferred variable over fixed. So preferring that flexibility over stability, if you like. And so what that's meant on a practical level is that every year around 10% of loans or mortgages originated are actually fixed. However, in 2021, thanks to term funding facilities made available by the RBA, that figure actually jumped up to 40%. And so those loans were fixed over 2 to 4 years. And so you can imagine that's going to roll off over the next few. And CBA have actually previously indicated that there'll be $53 billion alone will roll off in the second half of 2023. Now that's just for one bank, so you can get an idea as to how things might look and how that might weigh in on the consumer in 2023. And we think it'll certainly impact discretionary spend.
What are your preferred emerging sectors or stocks?
Probably following on from the last question as well, regardless of the economic environment, we're really looking for businesses with defensive characteristics or defendable positions. And so that's usually businesses with some degree of pricing power or an ability to compete on cost. And so we think a business at the moment that exhibits a few of those characteristics would be Collins Foods. So Collins have a better than average ability to pass on the cost to consumer, so pass on those higher input costs, which they've been doing. And not only that, but they've actually got planned store rollouts over the next few years as well. And so that enables them to have a source of growth in an environment where that growth actually might be difficult to come across if you were just relying on same store sales, for instance.
What emerging trends should everyone learn more about and why?
We think the auto industry is an interesting one. So you've got the obviously autonomous driving coming into the mix. You've got the transition to EVs. The functional aspects of vehicles and how we're using them today is changing as well. So just think of the increase in rideshare services and how that's taking place. But even if we just focus on EVs and we look at consumer behavior in the auto space over the past decade, a business like Toyota has really benefited from this gradual shift and transition towards your SUVs or your larger utility type vehicles. However, they're probably lacking a little bit in terms, or seem to be lacking in terms of EV development. And so you have to think about how that impacts the smaller businesses down the line. So a good example might be ARB. So we know that a proportion of ARB sales, and probably a large proportion, are related to Toyota products. And so again, so we're thinking about how are the decisions of these major manufacturers, how are these decisions going to impact these businesses, the smaller businesses down the line. And then in the shorter term, and look, it probably doesn't need any further coverage, but there is still ongoing supply constraints. So just taking the latest data available from the Federal Chamber of Auto Industries, we estimate we're still only around 80% of that pre-COVID sales volume. And so demand is still massively outstripping supply. So again, thinking about how do things look when that supply starts to come back and things start to open up. You would assume businesses that are involved with auto financing will do quite well, or any businesses that are exposed to OEM type sales. However, regardless of whether you're investing in the space or not, you're going to be impacted by these changes over the next decade. And so that's why we think it's an important area to understand or even consider.
Good morning, and thank you for the opportunity to present to the TCN Emerging Gems Conference. Pioneer Credit is a debt purchaser operating within the Australian financial services ecosystem. We're a top 2 provider to the banks in Australia in a very unique position with a fantastic market opportunity that sits in front of us. We have amazingly strong vendor relationships built over the course of the last decade and beyond that is valued by vendors and ensures continuity of supply of debt portfolios, which we buy from our vendors at a discount to their face value. And then we work with those consumers over time to get a good outcome for them and for us. We have a growing and sustainable income stream. We have a performing loan portfolio of some $460 million spread across a really diverse customer base that's been performing exceptionally well, particularly over the last 6 months, as we've seen cost of living pressures come into play in the Australian economy. Why are we successful? We do the right thing. We're a business that understands the value of our vendors, but we also critically understand the value of the consumers that we work with. We do the right thing. We represent ourselves and them with their best intentions, and we work with them on sustainable outcomes. We also have a best-in-class management team with decades of experience in this critical area of commerce. We know how to price portfolios very, very well. And we're aligned with you, with shareholders, in terms of our equity ownership. Management and board own some 21% of this business, ensuring exceptional alignment with shareholders so that when we invest money, we're investing it alongside you. Our focus in the business is very, very simple. Customer care. The end user, the customers that we work with, need our support and they need our assistance. And if we look after them, and we look after them very well, we'll be very successful. Our job, our purpose is to end debt stress. And we do that by working with consumers to get great outcomes. We provide them, and we do this through providing them with flexible outcomes. That means some of our consumers need time. Some of our consumers need longer than others. Others need the opportunity to settle at a discounted amount, and so forth. We work with them, providing them flexible outcomes that are good for them, particularly through these challenging environmental times. And we give back to the communities in which we operate. Pioneer is a business founded in good. Our people are founded in good, and that means that this is not just a business about making money, but we actually invest back into the communities in which we operate. And that is all around relieving debt stress and providing support to those people that aren't able to achieve that. In terms of our performance over the first quarter, the period ended 30 September, very pleased to announce record liquidations. This is our cash flow, the amount of cash that we received of $30.8 million, up some 27% on the prior corresponding period. We also had record EBITDA and record EBIT. EBITDA was up 45% to $18.6 million. So not only did we grow our revenue, but we did so in a way that was more economical, and that's good for shareholders. We also grew our EBIT a total of 332% over the period, a fantastic result, all of which are records, and set this business up for a return to profitability in FY23 and for a very, very solid end of this first half into the second half of next year. Importantly, there are also more opportunities for us to invest our money. Buying debt portfolios off the banks is critical to our success, and there are more emerging in a market with fewer players. Importantly, we do not buy payday loans. Our business is focused on quality and focused on ensuring that we buy the right customers who we understand and can price appropriately, and who we can work with to get great outcomes that work for them and for us. That makes our business exceptionally sustainable and is why it's successful and will become more successful over the years to come. In terms of our outlook, it's very, very clear what we're trying to do. We set our strategy out to shareholders and we deliver upon that strategy and report back to that strategy as we did last year. For FY23, there are 5 key planks to our business this year. One is to continue to thrive under the increased regulatory scrutiny. This is critical to our success, and the reason why it works for us is because Pioneer has a best-in-class compliance outcomes and gets industry-leading results. In an environment where financial services are under regulatory pressure, these are critical to the support of the banks, something Pioneer is very good at and very proud of. We want to capitalise on the opportunities. We've guided the market to an investment of $61 million this year. We've got about 2/3 of that already under contract, but there is opportunity to grow even more beyond that. And we will do that in time on the basis we can find the right opportunities at the right price point that's good for shareholders and one that allows us to appropriately service the consumers. Our growing performing arrangement portfolio, some $460 million, is critical to our success. These are customers that pay us weekly, fortnightly, or monthly, not dissimilar to a performing loan book at a bank. It's supported by about $1.5 billion in inventory, consumers that owe us those receivables that we're working with over time. We're very focused on growing that number beyond here. Operating leverage in this business, we've reached scale, so that means there's lots of opportunity to remove cost in a very efficient manner and one that continues to support consumers. We're working on that through this period. We've started to realise some of those costs already. And of course, we've got improving macroeconomic conditions. There are cost of living pressures in this business, and that's good for supply of PDPs. We need those PDPs to continue to grow, but importantly, it's not about the pressure there, it's about how we support the consumers that we're working with. And we're very, very good at that. We think that that's good for our business. This environment's good for our business. There are tailwinds that look like they're going to exist for some time, and that should see us through to profitability in FY23 and growing beyond. I'd like to thank you for your time and the opportunity to present Pioneer Credit to you today.
Hi, I'm Andreas Foras, and I'm incredibly happy to be presenting 4DMedical to you today. Here are the standard investor disclaimers. I'd like to start the story with you today talking about the size and detail of the market opportunity in respiratory diagnostics. While there's too much here to talk to you about in detail, the key features that we have are an incredibly large global market opportunity of over $31 billion per annum globally, and with a significant concentration of $13.7 billion of that in the United States. We also have significant concentration of the market into 4 technology areas. You can see here, X-ray, pulmonary function test, CT, and nuclear medicine. Between them have 99% market share. Additionally, it's really worth noting that there's a significant new opportunity here for us with Veterans Health in the United States. The VA, or Veterans Health Administration, is already a $250 billion plus per year healthcare provider in the United States. In addition to that, the US PACT Act has appropriated US $280 billion over 10 years of additional funding specifically for veterans who have been affected by exposure to toxic burn pits. And as you can imagine, there's the greatest portion of that directs us to lung conditions, and 4DMedical is perfectly placed to assist in this area. As we mentioned, just 4 technologies cover 99% of respiratory diagnostics conducted today. I'm going to quickly take you through each one of these. Spirometry, invented in 1846, is a technology that allows us to understand how the lungs are functioning. It's a functional technology. However, as quite an aged technology, it only gives us one-dimensional information. We blow into a tube and it measures how much air comes from all of our lungs collectively. So that means if some of our lungs are functioning above average and some below, we don't get to see that detail. And so it often hides diseases as they're progressing, which is the exact opposite of what we're looking in a diagnostic tool. X-rays, invented in 1895, are not functional. In fact, they provide just an image of how the lung looks. And as a still 2-dimensional image, firstly, the patient has to take a deep breath in and then hold still. And secondly, the technology layers all of that detail of what is present in the lung into one single flat 2-dimensional image. This image covers over small defects and small problems in the lungs, and once again makes them very difficult to find. CT is quickly becoming the gold standard. And so while it only has 11.8% of market procedures, has a much larger than that share financially of the current market. Technology is sensitive, but it's expensive and it's high in radiation dose. In fact, has about 70 times the radiation of a chest X-ray to conduct one CT. The upside is that it doesn't miss features. By being a 3-dimensional scan, it doesn't layer on top all of those structural effects at the same time. However, it is structural. It shows us a picture of how the lung looks and doesn't give us a picture of how the lung works. And so once again, can miss many things. I want to quickly introduce nuclear medicine, in particular, something called a VQ scan. This scan provides what seems like the best combination in terms of is quite functional, is multidimensional, but unfortunately has significant downsides in that it's incredibly expensive, also takes a long time to conduct, and while it is imaging, you might be able to see here on these images, the images are typically very grainy and quite difficult for the doctor to interpret. On the other hand, I'm very pleased to introduce to you here XV technology. XV technology is a 4-dimensional scan that measures lung function everywhere across the 3-dimensional structure of the lung, but across the 4th dimension of phases of the breath. So we get 10,000 measurements at 14 phases of the breath, each of which show where the air flows in the lungs and where it doesn't. It's incredibly rich information that allows doctors to understand what's happening in their patients' lungs with clarity that's just not possible using any other technology. So I'm very pleased to introduce you to XV technology. XV offers a 4-dimensional scan that measures lung function across the 3 dimensions of the lung, plus the 4th dimension of every phase of the breath. In fact, XV measures airflow at 10,000 points within the lung times 14 phases of the breath. For an incredibly rich amount of data that physicians can use to diagnose and understand properly for the first time what's happening within their patient's lungs. What's also very exciting about XV technology is it's layered directly on top of existing X-ray equipment that's already in every hospital across the United States, Australia, and indeed almost every hospital around the world. This means that we can utilize the capabilities of X-rays, particularly utilize the high availability and the low cost and low radiation of X-rays to do our imaging. So what that provides us in combination is, as a simple elevator pitch for XV technology, that this technology has the advantages of the top 3 modalities being spirometry, X-ray, and CT, without any of their disadvantages, into a single platform that has a significant opportunity to take all of their market share. That is that XV technology provides functional insight of spirometry, but at a regional level. It utilizes existing X-ray equipment, so it has similar dose and cost. Yet it provides a rich, detailed 3-dimensional scan, but plus with the 4th dimension. And while CT is only structural, this XV shows us function. With XV being such a powerful diagnostic capability, the final thing is to demonstrate the significant clinical utility. And as we've been rolling out XV across America and the United States, we have case after case of the clinical utility of this technology, which is something that we haven't had access to, as we began. This is, in fact, the evidence of clinical utility is the biggest change that 4DMedical has had over the past year, and really places us in a position to continue to accelerate our rollout across Australia and the United States. Let me just show you 2 key examples of that. Here, the first one is long COVID. In this particular case, we have a 52-year-old female who had acute COVID or severe COVID, and the CT show these white areas here, then effectively indicate pneumonia in those lungs. However, in this case, as the COVID cleared up, this patient did not feel better following the progression of this disease. And she didn't understand why she didn't feel better, and neither did her doctor. She got another CT scan, and the CT scan looks clear. But in order to understand what's happening, thankfully, the patient obtained an XV scan. And the XV scan showed that there were, in fact, the areas that had previously been occupied by pneumonia were not breathing as well, were not ventilating as well as the areas that hadn't. This allowed the doctor to make a decision to put her on therapy, on a drug treatment, and that drug treatment was incredibly effective. In fact, it was so effective that she wanted to, after a few months, stop that treatment. However, once again, follow-up scan from XV technology allowed the doctor to see that she wasn't quite fully completed in her treatment journey. So just a really very powerful example of how, on a day-to-day basis, XV technology allows doctor and patients to make the right decisions. And at 4DMedical, we firmly believe that better information leads to better decisions, and better decisions to better patient outcomes. Another really exciting example is from a clinical trial, looking at patients who had been exposed to burn pits, as we discussed before. And in this clinical trial, we have shown that while these patients, in general, have normal tests across all of the other modalities, so they have normal pulmonary function tests, normal X-rays, normal CTs. And so apart from the very invasive extrathoracic surgical biopsy, our test, XV technology, becomes the only test now that has been confirmed to be able to accurately diagnose this burn pit lung disease. This puts us in an incredibly strong position to work with the VA and to help screen the 3.5 million veterans who have been exposed to those burn pits. I want to briefly talk to you about commercialization. So we're primarily focused in two markets. I'm going to just talk to you now about our progress in Australia and in the United States. Incredibly excited that we've just recently signed a 3-year contract with IMED, Australia's largest radiology provider, with a 250 site network across the country. We successfully rolled out XV across 9 sites spanning the entire country. Also, we've now made a modified version of XV technology that is compatible, instead of using X-ray equipment, is also compatible with CT scanners. This allows access to the incredibly large number of CT scanners across the IMED network, and really will help us accelerate our rollout and be better partners with them. Also worth mentioning that last year we won funding, $28.9 million of funding from the Medical Research Future Fund, with $15 million yet to be received. And this has resulted in our deploying our first installation at Prince of Wales Hospital. And here you can see that launch, that opening ceremony. In the United States, which is of course a much larger opportunity, Australia represents about 2% of the global opportunity, and the United States about 45%. And in particular, the key asset we have there is $280 billion worth of spending that's been approved by the US government, specifically on veterans who have been exposed to burn pits, in combination with our recent clinical trial results showing that we have the best and most accurate tool to diagnose that disease. We also have exposure to outside of the VA and the Department of Defense. Providence is a hospital is a hospital network of 52 hospitals and 1,085 clinics across the United States. We've been piloting the technology at St. Joseph's Hospital in Orange County with great success. And the technology is being used there to screen multiple conditions, and the feedback from the doctors is very promising. In summary, we have a clinically validated technology that provides rich diagnostics, safer, lower cost, and better value to doctors and patients. We have a fantastic, very large global market, attractive growth opportunities, particularly in that core US market. We have top-tier relationships, whether it's our clinical trial partners or our commercial partners such as IMED. We have incredibly scalable software as a service business model with profit margins that can exceed 90%, a strong pipeline of new products, and a highly experienced board of directors and senior management to make it all happen. Thank you very much.
Jayride is a travel technology company at an early stage in a long-term growth trajectory. We help travelers find and book their rides around the world. That's shared airport shuttles, private cars, ride-hailing companies, names you know like Cabify, Uber, Lyft, names you don't, like a local operator that can take you around the Canary Islands, Malta, Santorini. We allow travelers to find and book all of these rides, and we are the largest aggregator of such ride service companies in the world, with over 3,700 transport companies that serve over 1,600 airports that represent 95% of the world's airport traveler volume. That's 95% of the destinations that travelers go. You can get a ride with Jayride. We sell these rides at jayride.com, and also we package them up and deliver them to the travel industry. Brands you know like Booking.com, Expedia use Jayride to provide rides to their travelers, bundling with hotels, flights, to make sure that every itinerary can be door to door. That's been a tricky problem for the travel industry to solve because there's lots of local operators, lots of aggregation to do. Jayride makes it simple. We allow travel brands to plug and play the entire ride service industry with a single API for an outstanding service every time. Jayride's growing, and to understand what happens next, it's good to take a look at where we've been. For over 6 years, Jayride was growing at double-digit percentage growth every quarter, right up until the pandemic. In 2018 and 2019, we rolled out from 5 countries to globally, over 100 plus countries served. And in particular, the 2 major destination markets that we opened were in Europe and Asian destinations. Late 2019, we had all that ready to go, and then you can see on the screen, March 2020, the onset of the pandemic, and Jayride lost 95% of its business at the onset of the pandemic. We got through on cost savings. We reduced headcount, and we ran a very lean ship to make sure that we were positioned to capture the recovery when it came through. Critically, we retained all of the key IP and all of the product and engineering group to make sure that we were building for that recovery as it came. So we found ourselves, as the recovery started coming through, well positioned to win market share. And that's what you can see here. As the recoveries come through, Jayride has outperformed. We've won market share. You can look at the European market pictured in yellow. It's gone to a multiple of where we were pre-pandemic. And that's as a result of that 2018, 2019 rollout, now capturing a lot of traveler behavior, a lot of travel bookings as the recovery comes through. Thinking ahead and what happens next, the Asian market in destinations that Australians love to travel to is now reopening. In October alone, we've had Japan, Hong Kong, Taiwan reopen. In the months since Bali's reopened, Bali has become Jayride's top destination globally. So we're looking forward to massive expansion across Oceania and Asian destination markets over the course of the coming quarters, and to continue to be a much larger and more profitable Jayride. In February, Jayride outlined what some would at the time say bold milestones beyond recovery. At the onset of the pandemic, Jayride was on a growth trajectory, but it wasn't anywhere near its full potential. And as in February, profits started to exceed pre-pandemic levels, we realized that we needed to set new and higher bars to cross. So we outlined a series of milestones relating to profitability, relating to powerful unit economics that scale, and related to overall scale and passenger trips booked. Every time passenger trips are booked, Jayride makes a commission on sale. That commission at net revenue per trip delivers the revenue for the company. At a certain contribution margin, delivers the profit for the company. And our objective was to become both larger in terms of scale and also more profitable in terms of margin than ever before. And you can see on the screen how we've been dusting off these milestones over the course of the following months. We're now looking at the next two milestones ahead. Jayride's progressing to over 1 million passenger trips booked at $10 net revenue per trip. Million trips at $10 each, Jayride will be a cash positive growth company. And that's just the first of two growth horizons. When we think about becoming the world leader, we are on track to deliver a vision of service for the traveler, where the traveler can find and book rides to and from anywhere on Earth. And that's a multi-million trip a year opportunity. At Growth Horizon 1, at 1 million trips a year and $10 each, Jayride is a cash positive growth company, but it doesn't stop there. Towards 10 million trips a year, we'll continue to build out our traveler proposition to a point where it's an unmatched technology that enables both travelers to have a fantastic experience and the travel industry to turnkey something that truly cannibalizes the taxi rack. So today, at today's scale and progressing towards 1 million trips, that's about cutting new features with regards to European regionalization, capturing that Asian destination recovery. But towards 10 million trips a year, we're talking a full multilingual platform with global source markets. Towards 1 million trips a year, we are talking about non-airport destinations like rail terminals, cruise ship terminals. But towards 10 million trips a year, that could be anywhere to anywhere. As a traveler progressing from your conference center to your airport or your cruise ship terminal to your hotel. It doesn't have to feature an airport. The traveler's problems extend beyond the airport. And then lastly, right now, focusing entirely on pre-booked itineraries, the traveler wants to be able to have a language that they know, a currency that they know for every trip they take, and without having to download the local ride-hailing app in order to get around. Jayride's got the ability to extend our traveler offer to travelers in their language and in their currency with no app to download so that they can truly get around from anywhere to anywhere, even while they're in destination. So as Jayride progresses through these two growth horizons, through cash positive, towards becoming the true leader in the market and delivering our vision that is door-to-door rides to suit every traveler's needs in every country, we'll continue to keep investors updated and we'll continue to improve our product at jayride.com. Thank you very much for your time and looking forward to sharing the progress with you as we go.
John Forward from Lowell Resources Fund. What are the biggest emerging trends that are going to impact the year ahead?
I think the big one that has been brewing for some time now is underinvestment in the resources sector. We've seen that investment has hit a 20-year low based on adjusted for GDP by major resources companies. And that's something that has been falling probably for the past 6 to 8 years. And it's probably best exemplified by the fossil fuel sector. Now, we all know why they're not investing in their own business. There's a lot of ESG pressure, but the need for oil and gas is not going away, as has been demonstrated in 2022. But in general, the big fossil fuel producers aren't doing anything but investing in their own businesses. They have been doing share buybacks, paying special dividends, investing in other businesses, anything from, say, wind farms to solar farms to look more green. So there's a brewing problem there of supply, and demand, as we've seen, is not going away. It's not forecast to start falling for oil, for example, until probably at least 2035. So there's a real squeeze there. I use oil and gas as an example, but we've seen it really right across the commodity spectrum. The big miners, for example, were accused of being profligate with their capital in the boom in the 2000s, the mining boom back then. And since then, they've been very quote unquote disciplined, but that has meant that a lot of projects, for whatever reason, have not been developed. So, for example, copper, other metals as well. There's a supply-demand crunch coming down the track at us pretty quickly.
And what are your preferred emerging stocks or sectors?
Yeah, so at Low Oil Resources Fund, we like to be a little bit counter-cyclical. So our main exposures are to gold and to copper. We do invest right across the commodity spectrum, so we do have a substantial amount of oil and gas, but focusing on gold and copper. Gold is certainly very much out of favor at the moment. It's off about 20-25% since its peak in US dollar terms in August 2020, but still a very handsome price of well over US $1,600 an ounce as we speak today. So gold producers, despite cost escalation, are still making money, but their share price is really out of favor. And we think that with the structural financial situation we're seeing globally at the moment, that the gold price will bounce back. And at that point, there'll be hopefully some real love for some of the gold equities. Copper, similarly, at the moment, the copper price is around $3.40, $3.50 a pound. So that's down from over $4 a pound in 2021, but still a good price. But you're seeing the prices paid for copper equities, in particular the pre-development companies that we focus on, are really fallen. The market's really fallen out of love with them. Not the only sector, obviously, but we're seeing some fantastic opportunities to invest in copper companies at the moment.
Finally, what emerging trend do you think everyone needs to know more about, and why?
Well, look, I've already touched on it somewhat, but copper in particular is forecast to have a major supply gap open up from 2025. Even today, we're seeing that copper inventories are very low. Visible copper inventories, I should say, in exchange traded warehouses are extremely low. They're normally measured in weeks. They're currently at around 4 days worth of global demand, which is not much. It's a wafer thin amount of copper in visible stockpiles. It hasn't translated to the price, and there may well be significant stockpiles that we're not seeing. But that's what we're seeing at the moment. But from 2025, we're seeing this demand supply gap open up, where supply is forecast to start to diminish from around 22 million tonnes per annum at the moment. And demand, due to the electrification theme, decarbonisation, use of copper in everything that is electrical, and that's that demand, particularly in electric vehicles, is going to grow and grow. And supply-demand gap by 2032, according to some commentators, is going to be around 9 million tonnes. So that's a 50% shortfall in the demand. That's including recycling. So there's a very scary situation that is forecast to happen. And I think, you know, the market seems to have its head buried in the sand in relation to it.
AdAlta is a drug discovery and development company. We use our proprietary iBody technology as a powerful drug discovery tool to develop high-value novel protein therapeutics for challenging diseases that have been underserved by traditional antibody technology. We're headquartered in Melbourne, where our talented team of 12 PhDs work in our laboratories to discover these amazing drugs. The best way to think about AdAlta is to consider some of the problems or needs that we address. The first problem is that while antibody drugs revolutionized the pharmaceutical industry when they first became available 30 years ago, they still can't do everything. And the search has been on for years to find smaller formats of antibodies that can do the same things, but in a much smaller package, if you like. And that's where AdAlta's iBody technology comes into play. We're about 10% the size of a traditional antibody and can access different types of targets than traditional antibodies can. And so we believe we have a solution to the general problem of how do you solve the drug targets that traditional antibodies can't work with. Now, getting more specifically, where are we developing specific products that can make a big difference to human healthcare? In the area of fibrosis, this is scarring of internal organs. There are huge unmet needs in multiple organ systems where disease causes scarring, which creates progressive and irreversible decline in that organ function. One example is lung fibrosis, where scarring of the lungs prevents the lungs expanding and contracting as well as they should, significantly reducing respiratory capacity. Now, in lung fibrosis, in kidney fibrosis, and in eye fibrosis, here we're looking at multi-billion-dollar markets that are really poorly served today. We believe our lead product, AD214, is a potential solution to the limitations of current antifibrotic therapies. The second area we're looking at for specific products is in the area of CAR T cells. So these are immune cells, a patient's own immune cells that are now engineered outside the body to be able to fight and recognize cancer, so that when they're given back to the patient, they can be primed, ready to fight the patient's own cancer. Now, this goes way beyond simply trying to kill the cancer with chemotherapy. We're trying to reactivate the patient's own deficient immune system. This is about turbocharging the patient's immune system. And the results for blood cancers have been absolutely phenomenal. The challenge we have today is how do we get that same response into solid tumours? And this is an area where we're working with our initial partner, Karuna Biotech, to develop these novel, what we call CAR T cells, capable of addressing solid tumours. This marketplace should be worth, or is forecast to be worth, over $20 billion by the end of the decade. And then finally, we're working with GE Healthcare to develop novel PET imaging agents to help us detect patients who are responding to the new immuno-oncology drugs much earlier than is otherwise possible. Today, between 20 and 40% of patients actually respond to these drugs. They get great outcomes when they do, but we can't always tell who is responding until about 6 or 8 months after treatment started. And that's probably too late. By the time they relapse, their cancer has progressed way too far. But we found, or GE came to us and said, look, can we image these markers of response using PET imaging, which is non-invasive, and if we can do that, we've got a much better way of getting these therapies to the right patients and the patients onto the right therapies much faster. The market for PET imaging agents is about $6 billion. The market for the new checkpoint inhibitor drugs or immuno-oncology drugs is over $100 billion. And so being able to get the right patient onto the right drug is a massive benefit for payers and the healthcare system in general. So these are some of the examples of the problems that we're addressing with our technology. So let's now turn to our business model and how we're actually realizing the value potential of meeting those needs. And let's also talk about the assets we have in development today. So underpinning everything we do at the bottom of this slide is our iBody platform. This is a powerful drug discovery engine. It's proprietary to AdAlta. It is what our scientists work on every day to identify specific iBodies that can help address the needs I described previously. We turn this into value for our shareholders and ultimately revenue for the company in two different ways. The first approach is what we call our wholly owned assets or internally developed assets, where we discover and develop a therapeutic through to the point where we can license that to a pharmaceutical company for final development and commercialization. In return, we would get milestones, upfront payments and milestones during ongoing development, and ultimately royalties from the commercialization of those products. Our lead program here is AD214, which is being developed for fibrotic diseases. It's completed phase 1, and we're working towards moving that into phase 2. The second approach we have is to co-develop molecules with partners who bring complementary technology. And in this way, we reduce the costs of discovery because we share those with our partners, and in some cases, they will fully fund the discovery process. And so we get a drug into our pipeline at a much lower cost. But importantly, they also bring complementary technology. So GE, for example, bring us the capability to label our iBodies with PET imaging agents, radioisotopes that enable the images to be created, which we don't have in-house. Carina Biotech, our partner in the CAR-T space, for example, brings us the capability to engineer a CAR cell on which we put our iBody binders. And so this is the second approach. And in this case, while we earn lower royalties and milestones down the track, what we do defray is our upfront discovery costs. So let's talk about what's coming as we demonstrate the future progress of these assets and what will demonstrate for investors and shareholders that we are continuing to make progress. On this slide, you can see the milestones coming in the first half and second half of 2023. In the past year, we've substantially added value to this asset, and we've gone from 1 indication and 1 route of administration to 4 potential indications and 2 potential routes of administration. And we've just prioritized focusing on injectable administration for lung fibrosis, kidney fibrosis, and eye fibrosis. And the milestones that we'll see coming in 2023 are all about progressing those injectable indications from where we are today through into our next clinical trial, which will begin in 2024. In our co-development program, we've added our second program and really launched our iBody-enabled CAR-T program through our collaboration with Carina Biotech. And so we now have 2 co-development programs running, and the milestones we're expecting are really about how do we demonstrate preclinical proof of concept of the drugs we're developing under those co-development collaborations. In red, you can also see that the partnering window is open for all of these, or for our AD214 asset and for our iCAR program as well. We're looking to add additional co-development programs or co-development partners into our iCAR program. And we're starting to have ramp up existing conversations around licensing AD214, potentially ahead of phase 2 clinical trials. So both of these collaboration types, while we're not forecasting specific timelines for these, certainly could add and provide the opportunity to add additional programs and non-dilutive financing to the company. So at a market capitalization today of around about $15 million, with 4 programs operational, 1 in the clinic, and the capacity to generate many more, we believe we're a pretty attractive investment proposition, especially when you consider that fibrosis assets have been transacted at phase 1 for up to $40 million upfront, which is obviously a significant multiple of our current market capitalization. And so we think there's a really exciting opportunity ahead of us. We'd be delighted to have further conversations with you, and for more information, please visit our website at adalta.com.au or contact us on inquiries at adalta.com.au. We've got a great, exciting year ahead of us. We're continuing to move our assets forward, and we look forward to continuing to deliver value and outcomes to some really needy patient populations. Thank you.
Thank you for joining us for the Capital Network's Emerging ASX Gems Investment Conference If you like what you've seen, please be sure to like and share the video, subscribe to TCN across all our social media platforms, and drop us a comment. Tell us who you would like to hear more from or be connected with, or if you're an investor, send us an email so we can keep you in the loop with the latest emerging ideas. To keep updated with all our developments, follow or subscribe to our social media channels. For now, thank you to our presenters, contributors, team, and importantly, audience. We value this community and we really want to see it thrive and wish you all the best in your investment journey.